of customer money that's looking for yield, then that's the risk those customers took by giving their money to Genesis to lend out. So it's possible that nothing, like no criminal, like no criminality happens, even if Genesis, goes belly up. And Barry Silbert wants to make sure that if Genesis goes belly up, then at least Grayscale is fully intact, which is why I am still not very concerned about GBTC, even though I hate the fact that he spread that product across the scammiest of shitcoins, including Ripple, by the way, which he had to take down the moment the lawsuit started of claiming their security.
Yeah. So the issue is did they do the question is, did they do a Celsius or did they do an FTX on institutional? I highly doubt they did an FTX, which is where you put the funds in custody and then you commingle them with what should have been sold as securities, and and therefore that's actually the criminal situation. Now, then you've got the Celsius. The Celsius is where they thought they were depositing and they thought it was a savings account with low risk, but it was actually investing in an illegal security and hedge fund. And what the issue was is that when people were depositing, it was a very misleading term because they weren't depositing, they were lending their funds, and it entered the balance sheet in the same balance sheet of the operational company. So they had full authority to spend those funds as they want. But the issue was they never sold it as a security, which gave full disclosure. And then that you can lose your money. So they commingled the balance sheets
with Celsius, so those were Celsius was yield bearing. Those were people who did have yield bearing
yield
accounts.
as a security.
Yeah.
So
they were yield bearing, but the issue there is that they had very high risk, like way beyond the risk that they had disclosed, because they had that guy who was doing what was it called, TrustFi, who was the guy who was actually managing the accounts. Thank you. Who was actually managing the account, but the KeyFi guy said that Celsius had said that they were hedging. And Celsius, of course, says, no, we thought he was hedging. And so they went into crazy amounts of risk, which generated crazy amounts of return until
it's the setup. So if you are a fractional reserve bank, then when people deposit, you're able to rehypothecate. If you sell it as a security, then you have to give full disclosures, but those securities are just segregated. It doesn't matter. It doesn't impact your balance sheet because essentially someone just made a bad investment and it blew up to zero, and it doesn't impact your company. When you have this hybrid model with no risk control, where people are lending their coins thinking it's a deposit, and then you start trading them, however you trade them, then when it blows up your company without the customer understanding that they invested in an illegal security.
Right,
I think the one thing about Celsius, so remember Celsius started as about banking the unbanked, but they started off as just low yield bearing accounts. That's when people were like, "I'm funding."
But that's a security. That's what I'm saying. You have to have.
But they were yield bearing, so they were improperly sold as securities. But that's a different issue.
No, the other way around. It was sold as a yield bearing account when it is a security.
Yeah, that is a security. That's right. They were improperly sold securities. But the difference between them. So the difference that I think that we're talking about here is when you put your money into an account as a deposit, right? This is the FTX thing, right? You put your money into an account as a deposit, and you're not anticipating yield. You're just anticipating that they will hold it
custody
for you. Then that is where there's the legal issue is they put it into risk-bearing accounts, right? They took
it was never custody. Otherwise, you can't offer it.
Right. I'm just trying to explain so people understand. There's a difference here between putting something in as just a deposit and then putting something in and expecting any yield at all. And that's why BlockFi and these others got in trouble. If you have any yield at all, you have to be aware that there are regulatory issues involved in that. You have to make a lot of disclosures, and you have to protect those investments differently than you would protect your own investments into those different securities. And what happened with both of these is that customer accounts got mixed into company accounts, and we're all invested together in risky ventures that were far beyond the risk of what the
Yeah,
customers
and
wanted. Now,
the
that's not the
loophole.
only thing that happened, but that is a thing that
No,
happened that made it a
but the
disaster.
loophole, the way they loopholed it is they said, when you deposit your funds, you're actually lending us your crypto. So they can then do with it as they choose, was their legal argument. So in the bankruptcy, what they're saying is Kirkland and Ellis, the lawyers, are saying it's our money, it's Celsius's money, it's not yours. Whereas with FTX, they're saying it's your money, and Almeida illegally used it. That this is it's a very different argument.
Hey guys, can I just interject for a second? With like, there's a lot of debate going on back and forth right now, but there's 7,500 people here right now, and I think that a lot of these kind of nuances and intricacies are probably beyond a lot of people's scope of knowledge. And I'd like to maybe see if we can bring it back a little bit to to just kind of what the implications are.
I will,
if
yeah. What I'll do, Kyle, before I give you the mic, I'm just going to summarize it for the audience because I was summarizing it earlier, then it kind of pivoted into a bit of a debate. So I was up to Q4. Genesis had $50 billion of loans. You added more numbers, Simon. But I'll move on. Both Genesis and DCG are currently raising capital. And then DCG has a lot of GBTC shares they could liquidate. And the question is, why is Barry not writing the check for Genesis? And then we got DCG already injected $150 million into Genesis last week. And then we asked the question, does DCG have more liquidity to bail out Genesis? And then Alex, you jump in and say you're probably not. That was a big statement there. And the conclusion, so that's a fair summary, Simon, just a very simple summary for the audience. Would you say that's fair?
Yeah, sure. And the important question is who writes the check?
and what happens if the check doesn't get written? That's what I'm curious about.
Yeah, well, then I'm not saying this will happen, but if it doesn't get written, then the good thing about Digital Currency Group is it's not like FTX, where I'm assuming we can't assume anything nowadays, but I'm assuming that it was a bunch of private equity, a bunch of real assets, and therefore those have to be distributed to creditors, which would decentralize the industry, where Digital Currency Group is a very centralized entity that owns equity in all of the ecosystem. And that would be awesome, but I don't want that to happen.
What implications does that look like for most of the people on this space right now? Because most of us are retail users who are kind of curious what's happening. What do the implications mean to us? Right, not the.
Basically, it means if whoever writes the check of the billion, so if CZ writes it, then Binance owns a massive, massive, massive chunk of the whole industry. If it doesn't, then it goes into Chapter 11. That will create, I believe, it would have a cascading effect on all the other companies. It would flush out all the fake yield. I don't think those coins will hit the market. I think they'd enter into a Chapter 11 process where they'd be protected. They can't hit the market.
Which coins? Sorry, are you talking about coins in Genesis portfolio?
So any company that goes into a Chapter 11, unless they get hacked like FTX, they all go into a protection where they can't be moved. So those funds can't hit the market until the bankruptcy proceeding is closed, and that normally happens where either there's fraud or something, and it ends up as a Chapter 7 liquidation. And the last criminal coins that we saw were like, say, Silk Road, and they were auctioned off. They never hit the market. It was only the Mt. Gox coins that ever hit the market, and that was a very unsophisticated move. Or they would just be distributed across all creditors, and the goal of their recovery would be based upon trying to ensure that all of this equity is distributed across all these creditors, because there wouldn't be a liquid market for selling all of that. So I don't think it has. I think this is really the final. If this were to happen, and I'm not saying it would, there may be someone that can write the $1 billion check. But if it were to happen, if that went into Chapter 11, I think we get a big, big, big knee-jerk reaction. And for the next year or two, we just essentially be distributing all these assets across the different creditors and learning the lesson. Oh, shit, we need to build. If we're going to do yield again, it has to be real yield, because this was all a house of cards dependent upon some tokens, and those prices going up forever.
Okay,
Yeah,
so
there's Simon. I was going to
Sorry.
say there's one more thing working in Genesis's favor. They did not have a scammy, illegal, unlicensed security like FTX did and Celsius did, right? So that's another huge plus sign. So I think that if Genesis does implode, a bunch of rich people are going to lose a cumulative total of 15 billion, and I'm pretty sure Genesis had the proper disclosure. So I don't.
Yeah,
While this is
it would
bad,
take out all
yeah,
the little crypto hedge funds
yeah.
though, because they've all got exposure.
Oh yeah, oh yeah. And Barry Silber's reputation would be severely damaged, and all he's going to have left is the GBTC product.
Yeah, which will probably be a pretty good trade.
I still think so.
I spoke to a crypto fund and asked them specifically, why do GBTC not enable redemptions? And they gave me a very interesting argument that Barry...
They legally can't.
Well, besides that, even if they had to push for it, they said, well, Barry makes his AUM fee on the net asset value, not on the price of the shares. So there's no incentive anyway for him to push it. So I did some calculations to work out, okay, on his 15 billion AUM, he generates $300 million a year in AUM revenue, which for me, if I come as an external investor and I just look at that purely, I think that's quite a healthy business, right?
Yep, he gets to sell
Incredibly healthy.
2%. Yeah, he gets to sell 2% of the 650,000 Bitcoin back in GBTC, and then he gets to double dip if he knows for a fact that it's fully backed. He gets to double dip, and if I was Barry, I'd be borrowing $1 billion and putting it into GBTC if I know for a fact it's backed, instead of bailing out Genesis, unless Genesis does have some kind of legal liability and they screwed up on some of those disclosures.
But also that also ties into the SEC deciding at what point to approve the spot Bitcoin ETF, because that's the killer of GBTC. But then they want to convert it. They've been trying to convert it into a spot Bitcoin ETF.
Right, and if Digital Currency Group is holding 40-50% of all of the GBTC shares, the conversion to an ETF could give them a beautiful windfall, making up for that, future gap in selling 2%. So they're just covering all their bases, where no matter what happens to GBTC, Barry still gets to make, a few $100 million a year.
it seems that we're all... No, I was going to read out a question. It was a funny joke, but I'll skip the joke. So I've got a question here from the audience, a very simple one and a very broad one. It seems that, the whole concept of bailout, some people are not understanding. So this is Daniel Haruni. I would like to ask, why are these big institutions bailing out each other? What's the incentive?
Well, the incentive of bailing out another financial institution is monopoly. If you bail out another financial institution and issue them a line of credit, you get to wipe out their equity holders.
And just to be clear, before you go into detail, just to be clear, when we say bailout, we're not talking about government bailout and where you just, the purpose is to help the economy. It doesn't matter if the asset is a good asset or not. Here we're talking about pure capitalism. So you're bailing out another company, essentially getting the company, the brand, the users at a discount.
Yeah, so that's a really important distinction. So a government bailout is a completely illegitimate bailout, and it happens when the consequence of crashing the banking system is too bad for society because they're systemically too big to fail. So you kick the can down the road and pay it through inflation, which is what we're paying for now. And so that's a government bailout. It's just essentially a political party deciding that it's political suicide to let the system roll out the debt, wipe out the debt. And it would be too harmful for too many people. And deposit insurance only covers 1% of all deposits in a systemic event. And so therefore you have to roll the can down the road and pay for inflation later and allow another political party to take that hot potato. That's a government bailout. A free market bailout is just simply the free market, which is a company comes along or a syndicate comes along and says, we'll give you a line of credit. And why would we do that? Because you're desperate, which is the 1907 JP Morgan strategy of issue a line of credit, and then you can wipe out the shareholders and buy the company for pennies on the dollars. And the reason that you do it is just to own the industry and monopolize. Then you have like a FDIC, for example, is where a bunch of industry players all contribute to an insurance fund. And then you have set terms and conditions by which you can do that. You can access that fund. The challenge with it is that if you had bailed out FTX, you would have wiped out the whole insurance system rather than actually flushing out all the fraud, which needs to be determined.
What do you mean? What do you mean wiped out the insurance system?
Well, imagine if everyone was contributing to a bailout fund, and then FTX was a member of the bailout fund, and then asked for a line of credit. Then you would have propped up an already systemically important company that was built on fraud, and you would have propped it up again, and then you would have put it off till later, which is what we're doing since the 2008 crisis. So rather than facing the issue, you make it bigger and then face it later, because you can't. This is the mistake of all Ponzi schemes. They start with a small hole, and then they believe they can trade their way out of it, and they make bigger and bigger bets and take higher and higher risk in order to solve the problem. And then that bet initially, when you have one bet that goes wrong, you end up doing more fraudulent things like borrowing client money, or pumping and dumping, or not dumping, but pumping a token in order to borrow against that token. That's the FTX scenario.
Also, Simon, there's many other, going back to the original question, there's many other capitalistic reasons as to why you want to bail out a company that could create systemic risk. If you do have access to their books and you know that, the company is running a fairly legitimate business that could potentially be profitable again, they just ran into an issue. You letting that company fail, yeah, you can probably pick up some of their employees on the cheap, but in reality, if that's a big company and a lot of jobs get wiped out, that could hurt your company as well, especially in the banking system. Then that means there's other people that can't pay their debts, creating more systemic risk. More companies could implode, and that doesn't do any good for your business. While if you do bail out that company, besides what Simon already mentioned, you could also get a good return on that investment, kind of like during the 2008 crisis. And I agree, they got bailouts for a disaster, but the car industry bailout is actually pretty. So,
I've just muted him.
But the better solution, the system that people think is illegitimate because of the Cyprus scenario, which is where Bitcoin got a lot of its traction in 2013. The better system for me is always the
Bitcoin got a lot of the traction from what in 2013?
When
Cyprus, the bank run, yeah.
Yeah, the bail-in is a much better system, because the bail-in essentially says, okay, everyone gets haircut. It was kind of the model we did with Bitfinex. We did the bail-in, which is where we said, right, let's stop this right now. 119,000 Bitcoins have been taken out. So we issued them a debt security. And those that didn't believe that debt security was worth $1, they were able to sell it for, I think it went to a low of 30 cents. But then as the company started trading and making profit, it started paying down that debt, and they were able to convert it to equity at $1 at par. And so you make all of the debtors shareholders, which is what I believe the solution should all of this be. So I don't believe in a bailout fund, because you're essentially hiding the debt. You'll wipe out the debt, start over, get out the fake yield, and give everyone equity in the company, and everyone becomes shareholders in the growth of the industry, and it decentralizes it significantly. So bail-in is where you just essentially give everyone equity in exchange for the debt.
Okay, so I've got another more technical question. So that's by Paul Sonius. If Grayscale Bitcoin is being custodied at Coinbase, then Grayscale becomes creditors' assets in the event of a run on Coinbase. Is this true?
Let me have a think about this. So no
custody.
Maybe
and then I'll just continue. Maybe they don't want to publish proof of reserves because it jitters the market. The jitters in the market can bring down Coinbase and Grayscale. I don't think that's correct, but I'll let you explain it.
Yeah. So custody. So at Bank to the Future, we have to segregate all client shares so that if our platform goes bust, another custodian can just take over, and those shares are all held in the name of the investor. Same with funds. If you deposit funds, they're held in custody. Our company can go bust, and everybody has they can get those funds. So you have these segregation, and the whole point of custody, if it's done properly, not just by name, is that it's actually fully segregated and sits off the balance sheet. So if Coinbase goes into bankruptcy, all of those custody funds are not involved in the bankruptcy proceeding. They are held in the name of whoever they belong to. And that's the whole point of custody. Is think about gold. Gold custody is where the gold custody company can go bust, but the gold still belongs to the people that it's meant to belong to.
This is a very important differentiator here to make, and that's where FTX got to confuse things. When it's custody, that money is that all they're doing is just storing that capital for you. So there's no rehypothecating. Finally, now I know how to say of these funds. That's not something what FTX did. Is not something that is done by anyone else. So generally speaking, when your funds are custodied at an institution, they should be relatively safe. Unlike giving funds and expecting a return, where those funds are not being custodied. Otherwise, you wouldn't be getting a return. Is that a fair, simplistic?
Safe as in they're meant to be fully legally segregated, and if somebody touches them, it's fraud and it's illegal, which is what happened with FTX.
That's probably the biggest. That's probably the biggest problem that we've seen with FTX. And would you say, Simon? Would you?
If you, for example, move, and here's the issue with FTX: if you don't have good systems and controls, and then FTX is offering yield, then remember, when you move it onto that order book and you receive yield on it, you're moving it away from custody, and you're actually investing it at risk, which is meant to be a security, which is why they were getting cease and desist orders from all the securities regulators, because you were just simply not understanding the risk in what you were doing. But it moves it from custody to, if it's a peer-to-peer model, then lending to the person that was shorting, essentially. Or if it's a model where it's done as a security. Those are the key distinctions. Now, FTX didn't, it appears, distinguish, and also Alameda was the biggest borrower of client funds, and none of the clients opted into that contract or that agreement, because Alameda was trying to get the returns, and they were representing it as a custody service, which in theory a custody service should be charged. So if you're not paying fees, that's really the key telltale sign, because if you don't know where the yield comes from, you are the yield.
Well, so
guys, doesn't Genesis?
One second. With custody, it is important to remember that if you are the custodian, you cannot move those funds without the approval of the person or entity whose funds you hold in custody. And that is one of the biggest problems that we have. Is it's not about putting something in custody. It's the fact that you're relinquishing control of that asset. That asset is you're entering something called a bailment. You are only holding that asset to protect it. And often that's why you see Coinbase, and I don't know if that's true of the ones that are held in Coinbase custody, but Coinbase accounts tend to be held in banks. When they say that it's insured, it's not insured by Coinbase. Your accounts on Coinbase are insured because they hold your money, theoretically, right, in custody in banks, and rely on those banks' FDIC insurance over those accounts. They're not allowed.
It's not FDIC. It's a private insurance.
It's not
like Lloyd's of London.
It's not SIPC. They actually do rely on because they're deposits. They're actually allowed to do this. They put them into depository accounts, and that's actually what they do now. But apparently someone's telling me that they're depositing on BlackRock. I don't know why they would do that.
It'll be a private insurance contract with like a Lloyd's of London insurer type thing.
Okay, but this is not the way that Coinbase, and maybe in other ones, they can do a private custody agreement, and that is a private insurance agreement, and that is essentially like the safety deposit model, right? But it depends on what they're doing.
It's not quite.
Wait 1 second. They put them. This is just U.S. law. They put them into U.S. bank accounts, and those bank accounts that are custodial accounts. So lawyers do this all the time. Those custodial accounts are then insured. FDIC insurance. This is what lawyers do. This is what we
you're
do.
talking. Yeah, you're talking about
no.
fiat.
But
you're talking about fiat. You can't do that with crypto.
No, they're not holding crypto usually, right? They're usually holding.
This is
they can
crypto
hold
custody.
some fiat, or they can hold some crypto. Now, with the crypto, the problem that they have, and this is something that oh crap, I gotta go.
No worries. So I'll finish off the thought. Basically, a crypto
I
custodian.
hey, Simon, let me say goodbye. I gotta go as well. Hey, Mario, Kim, thanks for bringing me up. I got a jet as well. Happy to join future streams now that I'm back on like the U.S. time zones and stuff. I was like all over the place last 3 months.
Cheers, Tone.
Thanks, Tone. Yeah, I'll let you finish that. Hold on, someone's muting. Thanks, Tone. Okay, cool. Yeah, sorry. I'll let you finish that thought, Simon. I've got a couple of questions for you. And I'm just for the audience, I'm going to put out a poll just in like the next 30 seconds, as usual, just to ask you guys what you'd like to cover. In the meantime, so what topics you'd like to cover. In the meantime, if you got any questions, put them in the bottom right corner in that comment section. Yeah, go ahead, Simon. I'll let you finish that thought. And I know, Bilo, you can jump in it whenever, man. You know the rules. There's no rules.
Yeah. So, all right, let me try and break it down. So if you put your money in a bank, obviously they're taking risks and they can create money every time they issue a loan. And so therefore you have deposit insurance, which was created in the 1930s Great Depression as a reform because banks collapsed. That insurance, FDIC insurance, is simply, if you want a banking license, you will have to contribute to be a member of FDIC. And that protects up to $250,000 of all depositors from a bank. But if you take the actual value of the contribution in FDIC relative to how many deposits it's actually insuring, it's about 1%. So if you go greater than 1%, which was 2008, where a number of banks go bust, then you need a government bailout. Now, let's relate that back to the crypto situation. So when you hold your funds with a custodian, the reason custody costs you money, it's a bit like the reason that no one wants or few like to invest in gold is because you actually have to pay to store it because it's an expensive process. And so you have an insurance syndicate that would insure the risk, which is essentially a bunch of private investors in the insurance market and reinsurance market. And they take on the risk and say, well, we'll give you up to, so for example, most of the custodians, they'll have about 750 million of coverage by a private contract with insurance that says if you get hacked, then we'll cover 750 million. Now, it's not actually, no insurance, as far as I'm aware, maybe someone could tell me, has actually paid out. I know that because I am a shareholder in BitPay, and they tried to exercise that insurance contract, and then they find all the reasons why they don't pay out. Typical insurance, right? So you have a private insurance contract with a custodian, because with crypto, you can obviously get hacked. It's not like gold in a vault where it can all run away. And so the important part about custody is that it's a different relationship, which is, that you're not allowed to use it. Or the company or the custodian is not allowed to use it unless they get explicit permission. And so if it was ever generating yield, it's because you, as a client, would have given permission for it to be used for something else. And if you are a bank, that's the key difference here. A bank can actually create money, but it's subject to all the regulations. It's a member of FDIC. It has deposit insurance. It has government bailout. It has access to, markets at the Fed markets. And it also has stress testing where you can't necessarily mark your assets like a shitcoin like FTT at market value. You have to actually mark it at a discount, and it's stress test and all the things that have developed over the decades and decades of scandals and mistakes that have happened over the last century.
Hey, Simon, so you just answered what I wanted to say, is that banks essentially do the same thing, except with very different stress ratios, right?
Yeah, absolutely. And that was the Lehman situation. They had all these illiquid assets where they couldn't ascertain because it had been sliced and diced so much, and then it was insured through other securities, through all the securitization. Essentially, Blythe Masters created the credit default swap, who later tried to tell everyone that you shouldn't buy Bitcoin. Blockchain's the innovation. But anyway, that's a detour.
So go ahead, Bilo.
Yeah.
Well, to your other point, you were saying about how a bailout could essentially lead to a monopoly situation. And I think when you follow the trail of events, isn't that kind of the conclusion of what's going on?
Yeah. So, I mean, whether it's done intentional, intent is a different thing, or whether it's just the way the biggest capitalist won and the one that played the game best, that's up to speculation. But yeah, it all moves to that. Now, this is an important. I'll just close the loop on because this becomes important for stablecoins, for example. For example, Paxos, they set up their stablecoin in a really interesting way, which is the stablecoin that sits behind BUSD. They did it where any funds are held in that within a trust bank that's subject to that $250,000 limitation, and anything else is invested in US Treasuries. Because remember, the only way, and remember FDIC, it doesn't hold money at a bank because then the FDIC funds could blow up if someone needed it because banks are systemically connected. They can only hold it in US Treasuries. And so in the end, the entire system is based upon the credit rating of the US government, which is the final part. Because if you want to protect yourself from bank risk, then you have to buy treasuries, which don't sit at a bank because that's a piece of paper that backs up the entire thing. So that's the final thing, is when your credit rating gets downgraded, is when you have a change in empire and the various things that follow, and a new world reserve currency or a monetary renegotiation. But yeah, the Paxos one, it holds it majority in treasuries.
I've got another question, Simon. And by the way, Jordan, welcome to stage, man. You can just jump in anytime. Don't never feel bad to interrupt, or you can put your hand up, bro. I appreciate you. A question here about the state of VCs. I know it's not too relevant, but relevant somehow because VCs are just getting liquidated left, right, and center. What's the future for VCs? Could we see more of them get liquidated now that the FTX, more dominoes could fall with FTX? And you know, how ugly could it get for VCs? And what does that mean for more VC money coming in to prop up the next bull run?
Well, it depends upon the distinction between whether they were operating as a VC or a hedge fund. So a VC typically is taking money that they pull together from institutional investors and family offices, and then purchasing securities. So they would own all of these, these companies. Where it got a bit murky is when the companies also started issuing tokens. And so the VCs started realizing that there's profit in being a hedge fund, because the whole point of a VC is long-term capital. So at Bank to the Future, we have all the securities, and we expect that to make a return in 7 to 10 years. But when the company also starts issuing tokens, then you can find yourself, the crypto VCs found themselves in a position where they can control capital, negotiate themselves a private equity investment, get bonus tokens, and then they become traders. So then they had to open up trading departments. And when they open up trading departments, they're deciding when to sell those tokens because it's startups that have a token that's instant liquidity. And there's a really, really good reason why startups don't have instant liquidity, because you take the founders away from productively building a business to speculatively building a business based upon when to sell their treasury, and protecting the price. And the reason companies wait till they're public to do that is because they just can't afford the resources, and also there's all the regulations around market manipulation that happens in a tradable liquid thing. So
and even became the best way to describe it is like every startup became an immediately public company, and then many of them were not ready for it, so they started obsessing over their token price.
But it's
yeah,
not.
and their customers make them as well.
Not just that they weren't ready for it, though. It's that it was illegal. It was illegal. They were holding funds that were privately attained, right? They were holding tokens that were functionally securities. This is what all of these lawsuits and stuff are about. These tokens are securities. They're trading on DEXs again, which is why DEXs are getting attacked. We're seeing that subpoenas are going out. This is why. This is the big
Hold on,
thing.
DEXs are being attacked?
Yes, DEXs are being attacked, and I know everyone thinks that they can't be, but of course they can. And like I said, subpoenas are out. But the important point here is that these tokens, it's essentially as if they got stock and they were starting to sell immediately. What
Exactly.
happens when you say something is great, you get something in return, right? And then you say, this is awesome, this is awesome. And then you start, and everybody starts buying because you said it was awesome. And then they start selling it on markets, right? And they're anonymously selling it. You don't know that they're doing it. So they're cashing in on the upside of everybody listening to them and saying this is great, or putting their name on it and saying this is amazing, I can't believe these people backed it. But they're not really backing it. What they're doing is basically a classic pump and dump, right? This is where
Yep.
they essentially are liquidating way before they're legally entitled to. Most of these would have been locked up if they were acknowledged as securities. These would have been locked up shares. They would not have been immediately liquid. They would have been controlled. There are now entities that you can use that will make sure that these tokens stay locked up and they don't actually exit the market. And when they do, they exit properly, as unregistered securities do under 144 conditions, etc. There are ways to actually do this, but they're not doing that. And that is the real problem, is that they used these tokens in the method that they were designed as a security, right, to provide them with some sort of return, but they didn't do it in compliance with securities. And what does that mean? That means that all the promotion that they were doing, all of the, yay, look, we invested, all those press releases, etc. We invested, we did these great things. At the same time, they were selling tokens. Why are the funds that were involved in Celsius and were involved in Terra Luna and FTX, why are they not howling? Because they took a lot of their stuff in tokens that are long gone. They're not sitting on a pool of investment that's now illiquid. Otherwise, you would have their LPs coming to complain. And that's not what's happening. They're mysteriously silent. This is the kind of thing that we see, like, how could we get the VCs in, like on the hook as well, if they're not clearly not looking at financial statements, right? Because they're still talking about stuff, like, not all of them, of course, but some of the very influential ones are not looking at financial statements because they're not seeing these huge disparities that are only widening, not increasing over time, between assets and liabilities, right? So the liquid assets is declining and liabilities is increasing, and they're still saying these are great companies and look at the market cap. Market cap doesn't mean it's a great company. It just means a lot of people put a lot of money into a market on it. So we have to actually remember that liquidity for a company in terms of their financial position is a very good thing. But liquidity for a company that is literally just its whole circumstance is about trading and making sure that it has good market value is a bad thing. So these are just they come to light more quickly in this particular market because everything moves faster in crypto. Things move faster, things happen faster. There's a lot more money, that our cycles are so quick. All of these things happen. So what does it do? It kind of shows us the errors, not just in crypto. This is a Web 2 problem too, right? What happens with crypto is that you have the tokens that are allowing them to get out of companies early. But does this mean that VCs only operating in Web 2 don't have a similar problem? I don't think so. I mean, it's the same thing that we say, oh, the securities rules don't work for Web3. That is true. A lot of it doesn't work for Web3, but it doesn't work for Web 2 either, right? Some of the problems that we're seeing are actually the same problems that we're seeing in Web 2, but they're on such a slow time frame and so much smaller, and they don't get the kind of press that we get, that we don't see them. But we need to look at this as a systemic problem, not something where there's one or two bad actors. This is a systemic issue that needs to be treated accordingly.
Alex, isn't that issue though easily solvable with longer lockups? I mean, why and how could somebody, why and how would a VC be able to dump tokens if they're locked up? I'm not sure I follow.
That's the problem, is that they weren't getting any lockups, and then even if they were, the wallets were able to transfer onto different dexes. So what we have now is we have entities that are providing custodial services with lockups that release them essentially on a time lock. Now, originally they tried to do this with tokens that had time locks on them, and that didn't work because people, for through various machinations, either evaded them or just changed them into something else that didn't have a lockup and then transferred them anyway. So now we have these custodial accounts that are there literally for security tokens. I think that's a great idea personally. My I don't know. My own inclination is always like, look, if it's protecting people, we should do it. That's my natural tendency, is if it protects people, we should do it. And why? For the reasons that Simon was discussing, of why is it bad for us to have very liquid tokens early on? First, there's nothing there that's of value. You have to wait for something to gain value, and that value has to be more than shareholders. If the value is simply shareholders, then you have essentially something that's, again, you have this pump and dump. There's nothing underneath it. We have to give these companies time to really build the companies that they have. We're asking a lot of the companies that build in this space by having them be like, fully liquid and generating high returns within months of opening, and that's not really viable. We have to give them, more reasonable time frames to become viable companies, especially because builds take a long time and you can't really pivot. So we have to be a little bit more generous with the builds that happen and not require them to be like essentially just these bastions of large cap trading when they really aren't underneath.
Yeah, so the answer to the original question is VCs need to become VCs again and not be hedge funds. Investors need to become investors again and not traders.
Yeah, I don't think that will happen though. I just really doubt it will go back.
It hasn't happened in traditional markets. So you're talking about a human psychology thing of fear and greed, and you accelerate it when you give instant liquidity to startups.
Jordan, you're muted, bro.
Hey, Mario, thanks for bringing me up. My first time talking on your space. Listen, as I'm listening to all this, I hear some things that are fundamentally I just have to disagree with.
Perfect. I like this. That's a great way to start, man. Great way to start.
So for context, I'm an investor and I'm an LP in many crypto funds. I'm a direct owner in a lot of crypto companies. I'm a shareholder in Gemini. I'm a shareholder in Deribit. I'm a shareholder in Animoca brands, and I'm like pretty well diversified throughout the entire space. And I want to clarify a point about the difference between VCs and hedge funds. They are one and the same. VCs oftentimes, most times, are hedge funds. They're put together with LPs. There's a general partner that runs it. And the capital is raised all the way from our high net worth individuals, accredited investors. Many of them these days are qualified purchasers, which is another level up. And I got to tell you, from the inside of a lot of these funds, I can tell you that they are absolutely capital strapped right now. They're unable to raise additional capital. If you go back 12 months, I mean, every fund was starting fund 2, fund 3, fund 4, because they had raised and already allocated and invested, their first fund 1, 2, and 3. Now what's happening is the only guys who are getting opportunities in this space to take advantage of, these distressed market conditions are the most recent raised funds who have not yet invested in a lot of the stuff that's happened over the last couple of years. And we're getting capital calls. I'm getting capital calls for my capital commitments to increase percentages of capital drawn so that they can deploy capital at this time. But I will say that almost every fund that I'm invested in as an LP is either not liquid enough to be able to take advantage of the opportunities, or 2, unable to raise capital. I think until a lot of this stuff really, until the sewage is fully exposed, I think most investors, whether it's institutional, or it's family office, or it's high net worth individuals, whether it's a accredited investor or a qualified purchaser, they all want to stay on the sidelines right now. And there's a lot of different types of venture capital or private equity that's happening in the crypto space right now. Like DCG is out trying to get $1 billion funding round by Monday. And that's not venture capital, but there's a lot of venture capital guys like Pantera, who are investing $500,000 million in very, very small startups that have nothing to do with actually owning the token. But there's a lot of stupid money that has entered this space. Smart money, I mean, guys with billions and billions of dollars under management, but they're stupid in the sense that they don't know anything about the crypto industry. And when they're looking at balance sheets of these crypto startups that print and issue their own tokens, a lot of times a big portion of the balance sheet is held in their own token. Almost all of them, by the way, just to contradict something that was said earlier, almost all of these deals, at least the legitimate ones, have lockups on the tokens. And right now, in an environment like we're in right now, is a really, really bad thing. So a lot of these VCs that put valuations on companies, let's say you valued a company at $3 billion, if 1.2 billion of that 3 billion is a liquid token on their balance sheet that they created, you just paid 1.2 billion more than what the company's worth. And that happened over and over and over and over again for like the last 12 months. I can tell you the really smart guys, I'm an LP in 10T, which is Dan Tapiero's funds, Fund 2 and Fund 3. Every time they have done a deal, whether it's a token issuer, which, there's a variety of companies that issue their own tokens, or exchanges like Huobi or Animoca brands, they print their own tokens for a variety of reasons. They basically take those token values and write them down to zero in their analysis before they invest. They don't want to be investing in liquid tokens as liquid token value. So, this is a super tough environment. I give DCG maybe a 50-50 shot at being able to raise this money. I think CZ might actually be the place that he goes. I don't know if CZ has an extra billion to throw at DCG right now, because DCG has a ton of shareholders and their capital stack is extremely deep. And up until October 31st, I also was an indirect shareholder in DCG through one of the funds that I was an LP in. Thank God I got redeemed on October 31st and have dodged major bullet in that portfolio. But at the end of the day, I think this mess continues. And I think DCG, if DCG doesn't get this bailout that they need, and Grayscale ends up needing to liquidate their trusts or unwind their trusts, like this is going to be catastrophe 3.0 for crypto. It's going to be massively bad. But I think, the future is bright just in the right things. And I think kind of akin to like the 2008 housing crash, which I was at the epicenter of because I've been a real estate guy my entire life as a commercial developer and investor. I can tell you that the types of crap deals that were happening in 2008 or prior to 2008 leading up to that crash are the same kinds of crap that has been happening in crypto for the last 2 years.
Can I ask a quick question? I just have a really quick question.
Sure.
Jordan, the funds that you're seeing, especially larger, are you like the name funds? Are you seeing them raise smaller rounds, or are they just not raising right now?
They're pretty much done raising right now. The only thing that they're doing is calling capital, like committed but uncalled capital. I would guess that in the next 3 to 6 months, we're going to see some of these larger funds come out with a new iteration, fund 2, 3, 4, 5, or whatever the number is, as a distressed asset fund to basically go buy assets on the cheap. No different than we did in 2009, 2010, 2011. You saw a lot of institutions come in and raise, distressed asset funds for real estate. I think the same thing's going to happen in crypto. We're just not there yet, right? We're still in 2008, 2009 from an analogous, point of view between real estate and crypto.
Yeah, and I think that's a better model than trying to bail out all the debt and rehypothecate the system further to a bigger mess. You got to wipe it all out and then buy it on distress. That's a much better model, I think.
Jordan, great stuff, man. We all learned a lot here. I'm glad you brought up Grayscale, and actually the question goes to you and Simon. What do you think is the reason why at this stage they're not approved as an ETF? And do you think maybe all the current events might prompt the government to accelerate their approval?
No, I think it will work in the opposite. And I think the SEC made a critical failure by not approving the spot Bitcoin ETF, and everything ended up in GBTC, which is a vastly inferior product. But the reason they did it is because obviously a spot ETF would be retail, and so then they approved the futures markets, and the futures markets were essentially the counterparties that they're already comfortable with, like CME and the bigger players. So I think it was a catastrophic failure. Essentially, we did everything in reverse. You had the trust, then you had the futures ETF, and now we still don't have the spot ETF in US dollars. So it's done in Canada and Australia and various other countries. It should have all been done in reverse, and I do think it's a regulatory failure. And I think it was, you can take either. You could say, the original reasons were when the Winklevoss were doing it, probably. Well, that's Gemini. They were doing it from I think like 2013 when they first started trying to do this. But the reason was that they didn't believe in the pricing and market manipulation because all the wash trading of all the exchanges. But I think it's an epic failure. I think they decided to not just focus on what products investors want and ensuring that they're transparent and sold as securities and all that type of stuff. Instead, they decided to play the role of VC and decide what type of product is suitable. And they decided that Bitcoin wasn't suitable because they didn't fully, want to put a stamp of approval on it. That's how it felt like me over the years. And I think we've now got a vastly inferior product, and investors weren't fully protected because of it, and they put more leverage in the system instead of spot.
I
The
can
real
tell you.
losers
By the
here
way,
are
I'm
the
not.
Web2
No,
investors, though. That's the thing, is the real losers are the Web2 investors, and the downfall of all of this is like Jordan was saying, if they go belly up, pretty catastrophic. And I don't understand why at this stage they wouldn't reconsider letting them be an
there,
ETF.
no, because Gary Gensler already gave the reasoning for this, right? So first is you should look at these applications. Some of them are total shit. They're impossible to approve, even if you completely 1,000%, love them. They're terrible. They're terribly done. They don't give any of the disclosures that are required. They're clearly just like, you should approve this, even though it's literally just, it's toilet paper.
We've
So
had
the
loads
first
of
thing
them
is,
from really competent companies like
no,
Van Eyck,
there's a
companies
lot
that
of
have had
shit out there. And remember
seriously.
that the guy who told us about SAFs, which are always illegal and still are, right? That person brought down, tried to bring down a law firm with what he did, right? A huge firm. Just because I worked in one of those huge firms, just because it's a huge firm doesn't mean it's full of good lawyers. They hide
Seriously,
crap lawyers there all the time. I mean
seriously, you think it was the lawyers weren't good enough?
I think very often it is the lawyers aren't good enough, but that is
Are you a
not
lawyer?
necessarily the reason that is not necessarily the reason that they failed. But I
Are
think
you a
that it
lawyer
is.
then?
I think it is. I think it is a reason that there's problems. But I mean, to that extent, I'm not mad at them because they give me work. I mean, when I was still doing that, they give me lots of work. So it was nice.
Sorry, are you a lawyer?
No,
I'm just
not from the law firms, from people who got screwed by the law firms and were like, now I owe a lot of money and I have nothing to show for it. Can you fix it? And that's what I did. But I don't do that now. I'm not trying to. I mean, I'm honest about where the flaws are. People are you? Wait, I'm sorry. Are you asking me if I'm a lawyer? Yeah,
yeah. I
I'm
was
a
just
lawyer.
wondering.
I'm a
Yeah, because I
securities
find
lawyer.
I find it hard to
I used
believe
to. I
that.
used to. Wait, 1 second. I'm a securities lawyer, and I used to work at the Securities and Exchange Commission. That's how I know a
All
lot
right.
of this stuff. So I'm telling you, like, I've seen these drafts. They're terrible and it's insulting. But nobody there takes it as an insult. It's just like, well, I'm not going to work with you if you're gonna put together shit like this. You clearly are just doing it in an obligatory fashion. It may be that the lawyers are doing the best they can with the information that
But
they
they
were
were like
given from
some
the
of them were
company.
actually
One
written
second.
by
One
ex
second. One
SEC
second. One
chairman.
second. 1 second. 1 second. 1 second. It may be that the lawyers were given that were just given shit to work with, and that's what they have. But part of it is that they can't approve something that is non-compliant from the outset. That's just not going to happen. But the second thing is Gary Gensler did actually say why he didn't approve spot markets, because he thinks, and I'm not commenting as whether or not this is a true belief. This is ridiculous to me, but he says that he will approve ones only on futures and not on spot market, because he says futures don't impact the price. So that is the reasoning that they're going with. They do not plan to approve anything that any trusts on the spot market. ETFs on spot markets are not going to pass unless and until that formal policy changes. But that's the rule right now. That's what everybody is working with. So no, they're not going to reconsider unless and until they decide to change the nature of that particular trust.
I want to kind of pivot to something else just quickly for the audience. I've just pinned a tweet above. Let me retweet it as well, if you can easily see it on my account. So the reason I did that is, one thing is just I've been witnessing as we do those spaces is we bring up good questions. We bring up two sides of every debate. And then we kind of, we've seen it happen a few times in the last few days, in the last week, is that we kind of force the hand of players to kind of respond or become more transparent. So I just did the tweet I did on. Yeah, bro.
Quick question. We've been here for a week now, right? Every day, we've been listening to all of these stories, everything unfolding, and I think the realization here is that this is really just the beginning of a much bigger problem. Wouldn't you agree that this feels more like, there's more to come, there's more problems down the road? Because when you hear all of these experts talking here and what the industry is facing, and what I found super interesting about what Jordan just said is that there's a capital drought now, and everyone is just looking for money to save their projects, and there's no money there. And then on top of that, we'll have, highly likely with what's going on with inflation, we will have a bigger collapse in the stock markets as well. So if you combine that with what's happening in crypto right now, there will just be no liquidity, and things are going to get much worse. Don't you agree?
Yeah, I'm more of an optimistic person, which kind of backfired on me because I've been optimistic before FTX and before Luna. So I think we're at or near the bottom. That's my personal view, but I think like the more shit there is under the hood, the better, the more impact we will have with the show, because what we're doing is trying to get clarity on that shit before people get caught up in it. That's my 2 cents on it. Not sure others.
The reason why I'm not so optimistic is because I've been around for the .com bust. I was in the middle of it. I had my own fund. Everything that I'm seeing right now is so similar to what I've experienced back then. Because back then also, we turned this whole new market into a huge casino. And that's what happened with crypto, and it's kind of disappointing because crypto was this promise of, new digital money that will set us free and give us control of our assets. And what have we done? We've turned it into another casino, and now everyone is losing money. And the thing that was actually the big achievement that we wanted to have with crypto is that we can compete with the corrupt, outdated financial system that's currently in place. And the whole gambling and greed element of this has literally set us back for years.
Hey, Kim and Mario, sorry, I'm gonna love you all and leave you. I think it's a really good pivot to what comes next, but I'm gonna let some of the other really great speakers come up and give more opinions. I just want to leave on one final thought. Bitcoin still exists. You can hold it on your Trezor wallet. It still has a fixed supply. It still allows you to earn your own money, and it still allows you to spend your own money.
Maybe Simon, maybe Satoshi took too much leverage we don't know about. I don't know.
It doesn't matter. It performs as originally designed.
Just joking, bro. Just joking.
We try and innovate all around it, and we come back to these cycles, and it still prevails and still survives.
And we did, and like, that's how I don't know if you were in the show. We ended a show. We were talking about NFTs about 3 weeks ago, and it ended with an ode to Bitcoin. Like, no matter what happens, Bitcoin is Bitcoin. Bitcoin is still there, and people that were praising Bitcoin and being made fun of during the bull run. Other ones left, having the last laugh. So it's a good reminder that you've made. I appreciate it, Simon. I know that
Okay.
Jordan and Wall Street want to jump in, but yeah, appreciate it, Simon.
Yeah, thanks for your perspective, Jordan. That was really interesting. Thanks, Kim. Thanks, Mario. Thanks, everybody. What was it? Is it crypto? What's your?
Alexandra.
Alexandra, sorry.
Oh,
Yeah, thank you
Hey,
very much
Simon.
for the
actually look
thoughtful
at my
debate.
profile, and it solves a lot of these questions. I'm just gonna say.
Yeah,
Hey,
sorry.
Simon, it's always good to have you here, man. You are providing a lot of knowledge and a lot of insights that only someone like you has, with so many investments and so many different players. So always happy to have you back, man. Please make sure to come back when you have some time.
Okay, thanks, everybody.
We
Bye-bye.
do love
Thanks,
having
Simon.
you. Honestly, Simon, it's been an absolute pleasure. Even though we disagree about things, it's absolutely a pleasure to have you here.
Oh, no, you hold me to account, definitely. Thank you. And that makes it interesting.
Thanks, Simon. Just for the audience, before I give the mic to Wall Street and then Jordan. So what I was saying is that the tweet I've retweeted and pinned above, where we ask questions and I put out the discussion into a quick thread. So just go in there, ask your questions, give us your thoughts, retweet it, etc. Because what's happening is every thread I do during the space gets a lot of engagement, ends up sometimes reaching up to 1 million people, but usually in the mid six figures. And then it kind of forces the players to kind of bring up more clarity or puts them under the spotlight. It brings more clarity to the space. So I try to keep them as objective as possible, as balanced as possible, and try to keep asking legitimate questions where there's reason to ask. So yeah, that just wanted to mention that. I think what we're doing there, and I'm going to the audience here, what we're doing in bringing awareness to those discussions by engaging on the threads and stuff is a bit impactful, because we've seen every time I do a space about a certain topic, the people involved in, I never call them out because obviously they're here to listen, but they join the space to listen. And that's happened time and time again. But yeah, Wall Street, go ahead, man.
Yeah, so I just wanted to expand more on what Jordan and Kim were referring to. Jordan was referring to how tough it is to raise capital right now. Kim was sort of going along that same thread. At the core fundamental basis, this is a repeat of 2008 in that the Fed keeps tightening. The Fed's balance sheet has declined from 9 trillion by almost 400 billion now to 8.6 trillion. So this is not going to stop. I mean, I know some people are wondering, is this the bottom? Is now the time to keep, to step back in? Just watch. The reason crypto had this huge boom was it was the era of easy money. There was, the Fed was adding 120 billion per month in liquidity to the system overall. You're not going to see these trends change until the Fed changes direction, until the Fed stops essentially destroying money, which is what they're doing by shrinking their balance sheet. So just on a more basic core fundamental level, for everyone who's out there wondering, is this the bottom? No, Kim's right. This is not the bottom. There's more to go until the Fed changes direction. So don't, I don't want to get deep into the crypto space. That's not my expertise. That's not why, I'm on the stage here or anything. I'm not a crypto expert and I'm not going to claim to be. But just on a core fundamental financial level, watch the Fed here, because you're not going to see easy money in this space for what Jordan was referring to, for anyone raising money, for more funds to be entering this space, for more venture capital to be entering this space until the Fed pivots. I mean, we get tired of hearing about it on when's the Fed going to pivot? When's the Fed going to pivot? What does it mean?
Yeah,
What does pivot even mean? You're not going to see a change of direction until the Fed goes back to easy money. Because
You're totally
that's
right.
And to speak to that point,
core
we had
level.
the Federal Reserve's Bostic come out today, and he said, I'll just read what he said today, because he's the only Federal Reserve to comment today about where they're going on rates. And he said, until inflation is on track to 2%, the Federal Reserve needs to, quote, resist the temptation for rate cuts, even if the economy weakens. He says the landing rate could be higher, but once reached, the Fed could allow some time to pass before further increases. He expects additional tightening of 0.75% to 1% point will be sufficient to control inflation, and also said essentially that he expects basically December to be the time frame where they can basically start, stop considering to continue to raise by 75 basis points. So that just gives you a little bit more picture. They're not really looking at pivoting it at all, but they are looking at maybe slowing down the rate hike.
Well,
It isn't working that well. It's part of it is
two factors. Go ahead, crypto.
Oh, sorry. Oh, so it's the wrong tool. It doesn't actually work, so it's going to be a long time before inflation comes down because of working through supply chains, not through this is just the wrong tool for the reason behind inflation. But the one thing that I wanted to point out is, what did we see during this 2020 boom that is so important? We had access for people who ordinarily don't have access into investment tools. And they jumped at it. They threw huge amounts of money without knowledge, honestly, but just because they were desperate for something, another avenue of gaining access to capital. There are only two avenues, and they've been only two for so long. They were so excited to have some other way to support themselves, right? Or to grow, to do something with their lives, right? Because it's so hard to get access to capital. And after 2008, banks shut it down even more, even though it was their fault, right? They shut down access to most people. They focused entirely on the top tier people. And what we saw is this huge pent up demand for people. The one thing that I want to see is, in this era of greater regulation, which is of course why I keep saying we have to write the bill. It should be us. We write the bill, right? I really want to make sure that we focus on protecting these smaller investors from being forced out of this space simply because they're only small investors, right? That's really what is happening, is that if you don't have enough money, you can't get access to money. That's not right. But that's really what is happening, is this huge chunk of people that's growing all the time that wants to be able to access things in a safer way, which I'm happy to say, like, let's put in safeguards and let's add education. Let's do a lot there. But my biggest concern right now with regulation is that it's going to shut out a lot of people who have access to nothing aside from crypto. Like, this is their access to financial tools. It's very
Alex,
important.
One comment on that, though, is that you can't, I think what a lot of retail gets wrong is that you cannot be exposed to high upside without high risk. And I think that is one issue that will be something that crypto always has to balance, is that, investors are going to always say, like, hey, I want that opportunity to have an upside. And I agree. Like, I think it should be like almost a human right to have the opportunity to have financial sovereignty over your assets. But at the same time, venture capitalists, many of them place 30 to 40 bets before they find a winner. And then that winner has to basically overcome all of it. So when you have, retail investors, I think they also need to be educated that, hey, if you go into a highly speculative asset, you have the right to do it, but there will be a chance of severe downside. And that is never going to change. No amount of regulation is going to change that dynamic that naturally exists in financial markets. And if it does come into the point that it does reduce the downside, it's going to reduce the upside as well.
Yeah, and then I want to go to a point. I want to quickly add to what Alex just said. I know Jordan and Magazine, you guys are waiting, and I'll go to Alex. But just want to add to your point, Alex. Like, during the bull market, retail complains that, hey, we don't have the same access as those VCs and stuff. And then the market implodes. They're like, hey, we need the protection. We didn't expect to lose everything. It's a really tricky balance. If we're going to accept retail...
It's not tricky. You're just greedy. Everybody's greedy. Stop being greedy.
Yeah, but because of everyone will be greedy, except VCs can, and high net worth individuals, they're able to be greedy and lose money because they got the money to do so. But then retail, someone has got a 9 to 5 or 9 to 6 job, and then coming in and trying to play the game and make some quick money, implosions to them means they got no money to pay the bills the next day. So that's like my argument. During the bull market, we kind of forget that, and then we start, trying to, praise retail having access to the NFTs or having access to tokens. But that means they got access to get wrecked like all of us, and like us VCs that we know what we're in for. Jordan.
But that's the difference. You know what you're in for, and they don't, because there's no finance taught in schools, at least in the U.S. Right? There's
but even if they're taught,
that gives them that information, But I think that the whole point, and that's literally what my podcast is. It is all just unbiased information and understanding this whole system, understanding news, and understanding risk. And this is the big thing. if we gave them, one second, if we gave them that information, if we taught them about risk profiles, etc., you're, just because you don't have money doesn't mean you're stupid. It means you don't have access to things. And I think
No,
that
that's
it's,
not true.
I
That's not,
I
that's,
don't.
I just, like, I have to really disagree with what you're saying. Like, I know that there's been a lot of proposals in front of the SEC to say, hey, you should be accredited if you take a class, right? If you spend a certain amount of, time or doing CEs, or, learning about products, or if you take a test that, shows that you're sophisticated. I say this in the absolute most respect to everyone. I don't mean to demean anybody, but to be someone who understands investment risks, to be sophisticated enough to suss out what is a good deal versus a bad deal, is not only an education, and education is absolutely part of it. I have literally been investing since I was 15 years old. I am 25 years into this, and I still lose money on occasion. Rarely, but I still lose money. And I can tell you that in 25 years, the one thing that I have figured out for me is that it's a skill set that is not necessarily just based on education. Some people are innately good at this kind of stuff. If you talk about Ray Dalio, or you talk about any of the other greats like Stanley Druckenmiller, investing well and investing smart and understanding risk, and understanding really what that risk means to you and to your future, is not something you can just teach people. It's impossible. Greed overcomes that. Emotion overcomes intelligence. And this was happening so much over the last few years in in crypto. Is, people knew this was highly risky. People were calling it a Ponzi. People were calling it a scam. People were saying it was equivalent to going to a casino and betting. And by the way, it was. And people didn't care because the gains were so good. You could throw a dart and buy any token or touch anything in crypto, and within 30 days, you were making money. And
But you're not even giving them the chance to develop the skill or see if they have it. If you cut them off entirely, there
I'm
has
not
to be
saying
a
to
way
cut them
to
off
bridge.
entirely.
But wait one
There
second. There
is
has to be a way to
crypto.
bridge being poor to being wealthy. And all I
Crypto, there
see
is.
are
There is.
bridges being cut.
You're wrong. You're totally wrong. Access to the stock market, access to, okay, forget alternatives, because, and speaking from experience, alternatives and private placements are fraught with absolute morons raising money, trying to do stupid things, who do not have the aptitude to manage other people's money. Giving them access to other people who can deliver great sales pitches but can't execute is not going to fix that. People have to walk, or they have to crawl before they walk, and they have to walk before they run. And when you're talking about building wealth, it doesn't come from one private placement that they can get into, right? It comes from saving. It comes from good money management in their personal lives. It comes from good business management. It comes from good capital allocation. It comes from diversification. It comes from learning lessons the hard way. And access to the stock market, which anybody has. I mean, even kids. My 8-year-old daughter has a stock account, is a custodial account in my name. Everybody has access to investments and the ability to learn, and YouTube and Twitter and the space that Mario so relentlessly puts on for people to educate them, to give them knowledge so they can listen to smart people. That is part of the process. Putting them through a weekends of education and taking a test so that they can buy private placements, which 99% are absolute shit, is not the right way to fix this problem. And it doesn't fix the casino problem in and amongst crypto. And people just believing that if their buddy and someone on Twitter says that XYZ token is going to go to the moon, that they're not going to throw 2 or 3 or 4,000 or 100 or whatever amount they want to put into it, and have this completely unrealistic expectation of what investing is. Crypto has been the epicenter of irresponsible investing for more than 2 years.
I am not saying crypto is not a center of irresponsible investing, but so are derivatives. So are a lot of other things that people can get into. Part of it is that these things have to actually, like, I wish the industry wouldn't fight the regulation so much. And then I wish regulation had a lot more information from industry, because all they get is the disaster. So we regulate in arrears. We regulate post disaster to prevent that disaster from happening again. Incidentally, it's the same way we do safety and security and things like, airlines and stuff like that. We wait for disasters because that's all the information we get, because the industry does not communicate with us what they're actually trying to do when they're trying to do it when we are regulators.
The industry does.
Wait. So that is one big issue. So I want these things to happen, and I can't make them happen, but those are the things that I want to happen. But the other thing is, we have this ethos of like self-sovereignty, control your own money, you're your own bank, etc. And at the same time, we're saying, well, no, you shouldn't enter into these deals. These are for people who actually know what they're doing. Oh, do you know what you're doing? Well, you're supposed to get some sort of education, but no, not the kind that you get, the kind that we get. We have access to this kind of education. We have access to being able to make more money. Oh, wait, now how do you get access to that? That's a really good question. Now, you can invest in these other things, many of which are equally as risky, but they're publicly available and way more expensive. Go ahead, go invest in those and get burned there. But it's okay, because that's a regulated area to get burned in. What we need to do is build better, right? Make better products, actually get, things that have revenue in them, things like that. But the other part of it is, don't say, because retail investors are in here, it's a bunch of shit. It is a bunch of shit. But what we have to do is say, retail investors are in here, so don't build shit. Don't build stuff that people can get hurt in. Don't sell stuff that people can get hurt in. Don't try to liquidate your holdings, because all you're doing is passing your risk off from yourself to someone else.
But people will still do it.
Behave better.
But people will never happen. We've existed for thousands of years. Humans are always going to be humans. Always. Like, we're so imperfect as a species. I don't think we'll build better. I don't think we'll stop dumping on others. I don't think insider trading will stop. I don't think none of that shit will stop, whether it's crypto, whether it's equities, whether it's, baseball cards. Humans are humans. And that's why I think, like, regulators putting in laws, and I'm one of the people that is not as critical as others on regulators. I just think they're trying their best. They're imperfect, and they're also, got the same flaws as, they're human as well. But I think that regulation is there, and I've said this a lot of times, to control these negative human instincts. Daniel, I know you've been waiting for a while. I'll let you, Daniel.
Can I
saying we
just
don't
speak
drag
Yeah,
women
Piotr.
home by their hair anymore, so we can evolve.
Go ahead, Piotr.
You know how much I appreciate you, but I do think you're being a little bit idealistic in this regard. I agree with Mario to a little bit. I think we need some degree of regulation just because of how gotten away it is. I'm not even remotely involved in it, and I just think I don't know, there's a lot of irresponsibility, and if there's inclinations about the same over, CZ as it is with SBF, I mean, we gotta nip this in the bud before the root causes are, really discovered and gets out of hand. But I'm just adding my 2 cents.
Go ahead, Daniel, and Jordan, Daniel, Morodi. You have to jump in, guys.
That was refreshingly short, Peter. Thank you.
You're a cheeky sod today, aren't you, Kit? You're a cheeky sod today.
Mario, thank you very much for doing what you do. It is very educational. I myself only started coming on this space maybe a week ago, and I've learned a shitload, and I guess I have a very simple but complex point or question for you guys. Hear your opinions on this education conversation that we seem to be having. How is regulation or rules or laws supposed to change in favor of the little guy at all when the average individual doesn't even know what the fractional reserve system is? I don't even know what the percentage is. Maybe you guys can take a guess.
Yeah, but
I
regulators are not there to educate. They're mainly there put in systems to make sure that the people that are uneducated, for whatever reason, they're maybe too busy in their job, or they're too busy living life and partying, that they're try to put them in a position where people that are more educated or that are deeper in the space don't take advantage of them, as we've seen in crypto, like the amount of pump and dumps, or NFT pump and dumps, especially recently, where insiders pump up an NFT project, retailers buy it, and then they dump it, or celebrities pump up a token project, retailers buy it, and then they dump it. The regulators are there to prevent those things, especially things like insider trading.
Yes, I
Can I
understand
just
that, but on the education tip, right? If the average individual isn't being taught from a young age what the fractional reserve system even is, they don't even know what 1913, the Federal Reserve Act of 1913 is. They have no clue what's been going on. How are
But
they
that's why, yeah,
supposed
but
to?
that's why they're not an investor, or they're not a manager of a $1 billion fund. They're a trader that's like trying to make a quick buck. Like this is the laws are there to protect those people from losing too much money while still giving them at least some exposure to the space. Jordan, I don't know, you wanted to add to this point?
Yeah, I just want to add that, like I've been in the securities business for a long time, because I've been not just an investor, but I've been an issuer, right? Like I've been a fund manager and a private placement syndication manager in the real estate business for years. And I can tell you that, over the last 2.5 decades, the SEC, both on a state level and a federal level, has really learned about real estate and syndications and how they work and how they should work, and they've put laws in place. But I got to tell you, like Reg Ds or Regulation Ds, private placements, the vast majority of them, they are unregulated, and people don't understand that. Like, they put disclosure laws in place, and of course there's laws against commingling funds, or doing things against the private placement memorandum or your operating agreement that you put forth to your investors, but there's really no control. And I think, to Crypto's point, she's like, hey, listen, we need regulation, we need regulation, we need regulation. In these private placements, there really is none, unless you do something contrary to what you tell your investors that you're going to do. You're not breaking any laws. You can say, invest in my private placement, and I'm going to take your money, and I'm going to go fly private jets around the world. I'm going to rent yachts. I'm going to have expensive dinners, and it's totally okay. The problem with regulation in general is that the Securities and Exchange Commission and the state regulatory bodies don't understand the investment or its purpose or its plan or how it's meant to work. And that is especially true with crypto. And so because they don't understand it, you cannot possibly expect these people to be able to create cogent, clear, intelligent regulation around it. And that's part of the reason why it's taking so long to get regulation in this space, is because to them, this is literally like looking at the surface of Jupiter. I mean, they literally don't know how to read it.
That's not true. It's not the surface of Jupiter. They have an understanding of how, like, securities and investments and crypto works. We're just not telling them what we're doing and why, which is again why there needs to be more flow of information, and why we need to write the bill. We need to write it should be us, because we're the ones who know what we're trying to do.
Can I throw a wrench in the gears?
Totally disagree. I totally disagree. I think a lot of people that work for the SEC don't have a clue. They're regulators. They sit in a cubicle. They read documents. They try to understand. They have absolutely.
I've thought that.
Yes, 100%.
That's not what they do.
I've thought that. I wanna agree on this one with Alex. Like Jordan, there's that narrative, and I'm not saying it's not true. Maybe it is, but we've had a lot of regulators come on the space in the last week. I've been surprised. I made a tweet about it. Some of these regulators knew more about crypto and DeFi than people within the space and those quote unquote influencers in the space. Just I want to give them a bit of credit there, because they surprised me in how much they knew. We had Mick Mulvaney, the ex-chief of staff, I think, or whatever, for Donald Trump, for example. And he came on stage. I thought, in my mind, I'm like, I don't know what to ask Mick. I have no idea what he knows. And the guy started bringing it. The first sentence that came out of his mouth was him talking about DeFi. I'm like, holy shit. So, and we obviously have Alexandra herself, ex-SEC. So I think they know more than, at least now, relative to before, they know more than we give them credit for. Not all of them, of course. I'm sure we'll get the odd one here and there that just say something completely false or misinformed. But that's my 2 cents, Jordan. It's like more of a speculation from
But
my
Mario,
side.
also to your point, they don't need to have the leadership know everything. They can easily hire subject matter professionals and experts.
Exactly. That's a
It's
good
not
point.
necessarily true that they have to
They
necessarily
don't know
know
exactly.
everything.
They regulate a lot of things. They don't need to know everything about everything. As long as they're in a position, like my job in this panel is to get the smartest people on stage that will disagree instead of everyone agreeing in an echo chamber. I can talk about literally anything. I can start talking about what's going on in Zambia tomorrow, as long as I get experts from Zambia that argue both sides of a certain argument. So a regulator is in the same position. Like they just need to get people against crypto and people for crypto. I'm being a bit generalistic here, and have them in a room debating it, and then come to conclusions on the space. So yeah, I agree on that point, Bilo.
I think also just to make a clear point here around, the debate of regulatory bodies, imposing good or bad rules. People are going to agree and disagree on that. I think the important thing here, especially for people trading crypto personally, is right. It's all about risk management. So in terms of just specifically security, like in discussing and thinking about FTX, right? That's an overseas exchange, right? So you don't have the U.S. government necessarily, looking into that company like you do for Coinbase. So if you were to just say, hey, what's riskier to trade on, Coinbase or FTX? I think it goes without saying, obviously FTX was much riskier, but I think even before this whole collapse, and obviously it's hard or not necessarily, it's impossible to know who's necessarily fraudulent out there, and there's going to be fraudulent actors across regulated and unregulated spaces. But right now, I think it's important to just discuss what people can actually do with their money that's exposed to crypto. So right, if you're trading on an exchange such as Coinbase, even though it's less risky than FTX, keeping your coins on that exchange is also more risky than putting it into cold storage, right? If you go to Uniswap and use a DEX, now you have protocol risk, you have execution risk, right? There's not as much liquidity necessarily. So I think it's just important to also just say, hey, regulation or not, in terms of what you're doing right now, there's a lot you can be doing from a risk reward standpoint that I think is more beneficial for listeners and people talking about this space than necessarily saying, hey, Gary Gensler, come on in and let's regulate this stuff. I think eventually, obviously, the free market will work itself out, whether it's with regulation or not. People can't lose a ton of money for too long and continue to come back.
Yeah, I want to go through to Chet. Chet, can you go through the breaking news? I know you've been waiting to jump in. You've got a few things, crypto and non-crypto, including a lot of developments on the Twitter front, which I think will be a key topic we'll be discussing tomorrow. Go ahead, bro.
Yes, just some of the news that came through on FTX, and of course, I'd like to, hear. I think we don't have Simon on stage anymore, but still, some different things that came through on the FTX saga. The first thing that struck me, of course, was last night after we had left the show. FTX finally ended up firing, 3 of SBF's top deputies. That would be Gary Wang, Nishat Singh, and Caroline Ellison, who, of course, ran Alameda Research for a really long time there as well. Then we've also had the GOP, the Republican Senator Hawley, who has now made a request to Biden officials and campaign groups saying, he sent a broad request for correspondence between federal agencies and Democrats, including the Biden administration and the House and Senate Democrats, campaign committees regarding bankrupt crypto exchange FTX and the trading house, of course, Alameda. He said he's trying to determine, this is according to Bloomberg, whether Bankman-Fried's more than $37 million in political donations to Democrats may have created pressure on regulators to be lenient with the former crypto executives. He said in the letter that, quote, billions of dollars were stolen from investors and handed over to Democrats and left-wing organizations. The fact that the scheme was revealed immediately after the midterm elections raises serious questions about whether federal regulators and law enforcement faced conflicts of interest in identifying, investigating, and thwarting the fraudulent scheme. And then, of course, the other news that we have as well is FTX John Ray, the new CEO, of course, from Enron. He came out with some new information this morning in regards to the standing of the assets in the business of FTX as he's looking into it. And they've hired a new investment bank to help the exchange sell viable parts of its business. A statement, and this is from the Wall Street Journal, a statement released today by Ray, the company's new CEO, struck a slightly more optimistic tone about the possibility of recovering assets compared with his previous dour assessment. If we recall, on Thursday, the veteran bankruptcy executive said he had never seen anything as bad as FTX in 40 years in the restructuring business. Quote, he said, "We are pleased to learn that many regulated or licensed subsidiaries of FTX within and outside the United States have solvent balance sheets, responsible management, and valuable franchises," he said. And then the filing identified 216 bank accounts with positive balances, offering the possibility that there is some value left in this wreckage for creditors to recover. It verified account balances worth about $564 million, according to today's filing. Much of that money, however, according to the Wall Street Journal, is either held in outside entities that directly filed for bankruptcy protection or is considered restricted cash, meaning others may lay claim to it. So just some interesting news there basically coming out as well on the FTX side. They said also here from the filing that it would look in the coming weeks, of course, to preserve or sell what businesses it can as part of the strategic review to maximize recoverable value for stakeholders. And then in a Saturday filing to federal bankruptcy court, FTX also said it doesn't yet know the total amount of cash that the crypto exchange or its related entities hold because of historical cash management failures and the deficiency of document controls. So they still don't have any information on that. And the company had been able to verify the balances in only some of the bank accounts held at 36 banks worldwide as of November 16th. So they say that they're in the process of locating additional bank accounts by, quote, reviewing the available books and records, speaking with bank personnel, and interviews with employees. So that's just kind of the major news there coming out of the FTX side, providing a little bit more of a picture on what might be the actual assets still left at stake here and what they could actually be able to give out to creditors. Now, keep in mind, $564 million is nowhere close to the amount of money that FTX owes on its liabilities, which is, I believe, over $9 billion or $10 billion, somewhere in that range. So just keep that in mind, too, as we're reading through these numbers.
Go ahead, Alex.
Thanks for the update, Chet. That was helpful, actually. I wanted to respond to just some of the comments about, regulation before. I do think to some degree the regulators are informed on this. I know Gary Gensler actually taught a course, I believe, on crypto economics at MIT. Whether or not they use that power for good or for bad of the industry is another story. But I do think there is some level of competency there for sure. I do think it's important, though, that the nuance of these different assets within crypto are also widely understood. So, for instance, the native coin of any layer one blockchain, it is a commodity because you need that to actually incentivize decentralized consensus. Whether it's
but Alex, the question is, when does it become a commodity from a security? I think that's what the tricky thing is.
So there's the Howey test, which tells you, it gives 3 aspects that define whether or not something is a security. In the case of, Bitcoin and these other ones, I guess what I would say is the reason why it's a commodity, right, is that you actually need that coin in order to use the network. It's the same way of the reason they call it gas on Ethereum is it's because it what actually powers the network and it's what you need to actually pay for. in order to get access to the energy in that network, because that's ultimately what it is. It's energy one way or another by the nodes that are running it. And so that's why I believe, all those layer one assets are commodities. And if you were to deem those all securities, there really is no such thing as crypto. Like it's not viable if you have to have, it causes centralization basically. So you'd never be able to have true decentralized consensus. And I believe that's why, Bitcoin, the SEC has rightly deemed, Bitcoin a commodity. Previous heads of the SEC have said, Ethereum is also a commodity, and that's one of the things that Ripple is trying to actually use as part of its defense, is to pull up some of those former speeches from the SEC head and actually say, hey, look, this has been commented on that it's not a security. So I think, that's one aspect. And then, within crypto, there's going to be all these new primitives that come up. And so we do have a framework for it with the Howey test that we can apply to all these different assets, and that'll raise the question, are NFTs, is that a primitive that's a security and whatnot? But I think layer one blockchains for sure are commodities. And then just the second piece is, again, I would come back to the point of like, assuming we can actually properly designate all these, there's always going to be this question of risk. And I agree with your point, Mario, like it's just human nature, right? And I think the fundamental question is, do humans have the fundamental right to do things that are bad for them? This isn't a question that's limited to finance. We let people smoke cigarettes, even though we know it causes cancer. We let people eat unhealthy foods and drink alcohol, even though we know it has deleterious effects on your body. And so, I think if you're going to go the route of like, assuming we can do a proper designation, and if some of these more speculative assets that have not only high upside, but high downside continue to exist, the question is, should retail have the right to do it? And frankly, if you're going to say on those more speculative ones that people shouldn't have a chance to do it, well, then they shouldn't be able to invest in high growth tech stocks. They shouldn't be able to do venture investing. They shouldn't be able to go to a casino and bet their money. This risk is a spectrum, and it's not just limited to crypto. And anyone who says it is just limited to crypto are more likely than not trying to obfuscate the risk in their own industry.
Alex, I'm glad you brought up Gary Gensler's take on Bitcoin, because he did say in 2021 that it was a commodity. So I'm just wondering, doesn't he kind of punt the ball to the CFTC on this?
Wait, you don't apply it, because he didn't actually say that. It's not actually, no. The futures are regulated as a commodity. Bitcoin and Ethereum are in this really weird gray zone. When he was talking about that, they seem as though they are, right? But this is not. First, we have to get a little bit better understanding about regulation in general. And I'm very sorry, Bilo, but this is, let's understand a little bit more about what regulators do and what they know. And first, they know a lot. I don't know why there's this idea that they're stupid. They're not stupid. They're really, really smart and from top schools. So I don't know what you guys value as, intelligent or worthy. And I have my own issues with the SEC, but I'm going to say in general, they are definitely not people that are like, oh, well, they can't understand this hard thing, So there's the way that that they're regulating. First of all, second, I guess, the Howey test is not the only test for securities. It was in one no action letter, and everyone jumped on it like it was the cure for cancer. It's a thing that's part of a thing, and a list that is one of several lists of things that maybe always are or never are securities, right? So if it was as simple as the Howey test, there would not be securities lawyers. It's not like that. The reason DeFi is full of securities has nothing to do with Howey. The reason some of these issues are have securities issues also has nothing to do with Howey. That's one thing. The other thing that you need to know is, where does policy come from? There were a bunch of people that were relying on people like Hinman to deliver policy. They started saying, no, it's decentralized. We can't possibly regulate it. First, not true. Anything done by people can be regulated. Second is, that's not where policy is generated. That is not a policy decision. He was the director of CorpFin, the division I worked in, actually. That's not where policy comes from. So you can't rely on these things and then feel betrayed or whatever when it doesn't work out, because you have to understand more about regulators. And that comes from feeling like they're helping you. And there's a lot of people, there's some wonderful, wonderful comments that I've gotten. Thank you all so much. I appreciate it. And some who are not thrilled, especially when there's someone who used to be a regulator on stage. I get it. But it's really important that we look at regulators as people who understand that technology is good, that moving forward is good. Many of them know about, if they didn't live through it, they know about the .com, disasters that had happened before. They do not want retail investors to be screwed. That's literally the only goal. Don't screw retail investors over. Screw each other over if you want, but don't screw over the retail investors. And that's what they're looking for. So if you think about it from that perspective, we think about building products that don't do that. Like, we give access when the access is warranted according to risk, or we inform them about the risk that's involved. So I don't like, according to, Jordan, who said that we should, well, there's too much risk for them. But again, we don't dictate what someone's risk profile is. We don't dictate whether or not someone has risk tolerance. The SEC doesn't approve or not approve any particular type of offering. All they say is disclose it. If you do it, you got to disclose it, unless you're in one of a few different areas that are much more regulated. But for the most part, that's all it is. And we're treating that like that disclosure is a terrible, terrible thing, when in fact, the disclosure actually protects companies more than it protects investors. And
Well,
these are
I
just,
think you're missing some important things, though, Alex, right? So the first thing is that one huge difference between crypto as an asset class is that it is globally available. It isn't like assets on, the U.S. stock market, where you only have to consider, the actual U.S. citizens. These are global and decentralized systems. And I think that's where some of the pushback comes from, is the fact that, there are many countries in the world who are participating in these digital economies and building on top of these platforms. And so they all deserve a right to do that as well. And, moving towards this concept of it.
But no one at the SEC is saying that they don't have the right to do that. They're not saying that. I mean, in fact, the other countries are looking at us and saying, how do we regulate this? Those are actual meetings that have occurred.
Of course, yeah.
So,
No one's saying there's not. I'm just giving the other side of what makes it different than other asset classes. And then,
but you don't think that only U.S. companies are on our exchange, right? You know that foreign companies are on our exchange.
Yeah, of course. No one's saying that, but they have to go through the U.S. is the bottleneck there, right? And that it isn't the bottleneck for Bitcoin. It can still be the leader, but that doesn't mean it's the only one, which makes it very different than listing on other types of exchanges, because ultimately you do still have to get approval from U.S. regulators. And while the U.S. will always be a central player in this, it is important to realize that this in itself is part of why Bitcoin was invented. I think the other thing you have to keep in mind was that the Bitcoin white paper was literally written in the aftermath of 2008, where regulators did not protect us and where they actually were allowing these malfeasance to happen. So, if people are wondering, why are so many people in crypto opposed to regulation, it's because of the clear decision that we did not have trust. We didn't want to have counterparty risk. We didn't want to have to trust people. People wanted to put their trust in actual math, right, and have crypto economically secure systems that the internet was built off of. So, the idea that...
Okay, but from the regulator perspective, and this is the Enron phase, et cetera, right? So between Enron and 2008, the banking crisis, which, was only, that's a separate regulatory entity, right? But for this particular period, there are 350 people that work at the SEC dealing with filings. And we never got an increase and we never got a pay raise, right? We never got anything like that. So you're asking for somehow this small group of people who cannot get the resources that they ask for. They're not congressionally approved because nobody wants to give additional resources. We don't like to give money to regulators or to infrastructure. Or schools, right? Those are the three things we hate, and we hate giving money to. We don't want to give money to jails unless it's for walls and bars, right? But everything else, we don't want to give money to those. So there were no resources. And so 350 people split between lawyers and accountants, right, are supposed to be able to review everything. That's not how it happens, right? We review
Alex, you're taking this as a personal attack on regulators. Nobody's personally attacking regulators here. Nobody.
am.
I appreciate that. I'm just
Sorry. Speak
the
for
point.
yourself. I'm attacking them.
But the
I
people
am as
that
well.
work,
Okay.
the people that
Fair
work.
enough. And I am not all regulators, right? And I'm not even one right now. I'm just saying that there's this misunderstanding that they're like a bunch of idiots that are like, there's no cubicles, by the way, but that are just sitting around in cubicles and like veal, right? And just passing things and have no interest in what's going on, and they have no interest in changing rules. What we always faced when I was there, at least, is that trying to get information from industry was worse than pulling teeth, right? It was so hard. Everybody just wanted to stay under the radar, and they didn't want to talk about what they were doing. They just hid it. We don't have people going
But
out
the
into
people
the
that have
field
tried
and
to
invest.
engage, though, have all been burned. I mean, what's going on with Grayscale and the Bitcoin Trust? What's going on with Coinbase being attacked by regulators? So as a result, everyone had to go offshore to FTX. And by the way, who is FTX working with directly? Gary Gensler. So, where the distrust comes from, and the reason people don't want to invest in them more is that his track record is terrible in this space. It's prevented none of the major disasters we need to happen. And some of the best actors in the space are the ones that he continues to put in his crosshairs. Like,
I did it. Just I want to get while we continue this. I did it. Just a quick poll for the audience. Your thoughts on regulators, because obviously, we got people split on both. I'm on the positive side. I think we need them. Others are not. I've also just quickly. I've just tweeted the space for tomorrow. I forgot to do that earlier, so you can register. Everyone, turn on your reminders. I've just pinned it above and on my profile. But just back to the regulators discussion, I'm just going to watch the poll, see what the audience thinks. My position, guys. I'm more on the positive side that we need them, but obviously a lot of others would disagree.
But just
what
to
is
build on
this
what I was
animal
saying,
called?
sorry.
That just a second.
Go
What is
ahead.
this animal called that lives in trees and moves like really slow? So it has like all this
Chameleon.
mold build up.
What?
This mold is
Sloth.
building. All
A
this
sloth.
mold
Oh, a
is building
sloth.
up in
All
its
right.
fur.
Okay. I thought it was more crafty
It's
than
a
that.
sloth. Yeah, it's sloth, right? So that's how I feel about regulators. Like in all these years of crypto, name one really useful regulation that came from these people.
Tim, my bro, what I was saying earlier, and I really want this to be clear, at least from my perspective. Regulators are human beings, like I think Mary was saying earlier, and they work for a boss. And I think it's the mandate that their bosses put through that they have to work with. This is when I say nobody's blaming regulators in the sense of people working in those cubicles that Alex was talking about are only following the mandates set forth by management. And I think management is the problem. That's the problem, not the people that could effectuate change.
Congress is the mandate setter. We merely enact and interpret. That's it. But Congress, this is why I'm talking about this law, the bill, over and over and over again, because the rules don't come from the regulators. They don't come from the executive branch. They come from Congress. That's where it is. If you don't like the laws, you have to change them by going to Congress. There's no other way to do it.
Guys, I see King and BitChack. You guys hand up. You just got to jump in. Don't just wait.
Yeah, I want to jump in. I just want to emphasize that, as I say, I come at this from a very external angle. I've been listening for hours at this point. I think there's validation on both sides. For me, and again, take my limited 2 cents on this, but I do think at this point we need some kind of conversation about types of regulation, not just because of what's happening in the US, but just around the world. There's so much variation when it comes to crypto, attitudes around crypto. And as I said before, personally, in my mind, I think there's a missed opportunity here to open up to more countries were there to be like a skeleton framework, maybe not some overbearing set of intricate regulations, but a loose set of guidelines and by which countries can then develop their own, and they can see which countries are more, and then you can see as people who are engaged in it, which countries are more regulatory, which are not. Europe has already made it very clear that they're going to crack down on this stuff because they think it's an exploitation of vulnerable people or financially unclear decisions. So that maybe then works against them, and you get countries that are more open to crypto, and therefore you get better opportunities from it. So it's a sort of, I know it's not overall sounds great, but in the net positive, you do the pros outweigh the cons. But I understand it's not that black and white.
But if you got to go back to the track record,
infrastructure of regulation is actually about to change. It's all shifting. So you won't have as much jurisdiction hunting as what you're describing is basically like people who are jurisdiction picking or jurisdiction hunting, where they find the best jurisdiction for them, which is totally fair in my opinion. But that's not going to happen anymore. An entirely new system. What I talked about at Web Summit, right? I mentioned this, but that this is what we're talking about now is this new regulatory structure that's coming in.
Yeah, and I
Guys,
just add to that.
okay,
I've been in touch with people at the G20. I've got a couple of colleagues who were working on a couple of the different delegations. So I'm going to try and get them to come in to share some of the insights, because G20 it's very, very, I know on the looser end, and it's not going to make any difference immediately. But I think it'd be interesting to hear from them on the inside what was discussed from the sort of countries that are looking at trying to get some kind of skeleton framework. Because interestingly, as I said before, it wasn't the West that was predominantly about this, it was India. We've heard some people from within the country talking about their concerns around exploitation, and so it's interesting to see what other countries along those lines want to try
and I want to go. I'm quickly go to the Piotr. I want to go to the audience. I love how fucking every time I do a poll, it's usually always split. Almost 50-50. Yeah, not mental as well. Like how split they are. Like this shows that this is not an echo chamber. I'm gonna make a tweet. Like I put it, schedule it for 3 hours from now. I'm like, if you agree with everything on stage, means we're not doing a good job. So thoughts on regulators? 46% love them, we need them. 53% no, hate regulators. So it's like pretty much 50-50. I freaking love this. Whenever the audience is split, it just shows that we're covering, debating both sides really well. But go ahead, King, Thierry, Jordan, go ahead, guys.
Okay, so can I say something here, because we've been listening to the same thing for a while now, and yeah, the audience would like to say a word. So on your regulation is a load of shit, because it's only impacting freedom and not anything that protects any of the plebs in society. The regulation is geared for the more sophisticated people that are connected to the right entities, and it's definitely a organized system to protect the elite. To give you an example, to take away somebody's freedom to be able to do something and grant another person access to that clearly is a division within society. So when regulators respect freedom, we can maybe start sitting around the same table. So Alex, I'm quite with you with regards to the whole regulation and how it encroaches on people's freedoms rather than giving protection. So I would like to ask you guys, because I haven't heard anybody actually mention that, especially from the regulator side, that their first and foremost focus should be on, are they actually protecting the freedom of the individual? They all want to protect you from losing money, but they don't really, because you can go fucking lose money anywhere in the country. Go to a casino, you can go to a gypsy down the road, you can go to a scrupulous second-hand dealer, you can lose money, and the regulation don't save your ass. So from a more positive view towards regulation, I would like to put the following. When you do fraud, one of the pillars to fraud is misinformation, and misinformation should be the priority when it comes to regulation. So if the seller, and only the seller, not the buyer, because he must have free will and free in a free economy and a free market. So the seller should be obligated to disclose so that there's no misinformation, because that is where the loss starts, when you don't know what you are dealing with because you were misinformed. The second thing that regulators should look at is categorizing certain assets or items of sale within the financial market. So when you know you're buying a blue chip product, you know it's been around for so many years, it's got a certain capital evaluation, and if you're investing in penny stocks, you know it's not the same thing. But even in penny stocks and in blue chips, you are not being told by the regulator what the fuck it is you're actually investing in, because the full disclosure is not available to the small guy as regular as the insider. So when a deal gets made at any level, the disclosure of the deal details should be the focus, not whether the person qualifies to do the deal or not. That's money. If you got the money to buy the thing, you should be allowed to buy it.
Check.
That's all.
Would you mind if I answer? I think we have to take the conversation in context of why we're here in the first place. Why are we all here right now? We're not here really because we want, to discuss regulation. We're here because there is a need for somebody or a body, we're calling them regulators, whether they be government or not, to make sure that you can transact safely in the space. Safely transacting in the space does not at all imply somebody telling you where you can and can't invest. So we're not talking about regulation in the sense of somebody or an organization coming in and saying, you are allowed to invest here, but not there. We're only talking about safety within the space. So
but
that
that's
you
not
can
what
still
the
make.
SEC is talking
So
about.
wait a second. If you're telling me that, why can an accredited investor and a non-accredited investor not invest in the same shit?
So these are laws that are particular to different countries and jurisdictions. They don't apply across the board.
But we're talking generally worldwide regulation.
Yeah. So, but in this
So
particular,
in those countries where it applies, freedom has been eroded.
But
And you guys telling me you worry about the individual.
No, but I'll just say again.
Can I add
So
something here?
it's very jurisdiction dependent, first of all. But again, the context of this particular discussion now has the genesis of what happened with FTX and people losing their money and their funds. So the regulation.
And that's because you weren't informed of what FTX was doing in the background. It's disclosure.
That's not fair, because no, you can't say we made a mistake.
What do you mean it's not fair? What the fuck? If there's a rule that says you must tell the person what you're doing with his money.
But that's why we need regulation, buddy. That's why
no,
we need somebody.
That is what I said. Those are regulations that can be acceptable.
Okay,
but regulation that encroaches on your freedom is a fuck up.
But we're not talking about regulations that encroach on our freedom. We are only talking about regulations.
You are. You're telling me that if it's a certain type of asset and I'm not a accredited investor, I'm not allowed to invest in it.
I didn't at any point tell you that, nor was I a proponent for this.
That is what the regulation says.
But
can we let one person finish before we keep chiming in? It's a bit difficult to follow the conversation.
So that's not what I was.
Well, then don't talk shit.
No, mate, just let Bilo finish, yeah? Let Bilo finish.
Thank you.
Hey, Bitcheck, in your profile it says you're the creator of Bitcoin. I never thought Satoshi has such a foul mouth.
Well, let me put it to you this way. It's either me or it's that guy from Bitcoin SV. And I know you like him.
Yeah.
I don't like him. What are you talking about?
So just to put things back into context, Bitcheck, I want to just make it very clear. I don't think there's anybody here that is advocating towards a regulation that stops or tells people where and what to invest. We are only talking about regulation to protect the consumer from being rugged by an exchange, as an example.
That's not what the SEC is talking about, though. Gary Gensler very specifically is trying to deem what assets people can and can't do. I mean, he's blocking, Grayscale from getting their ETF approved right now. So I don't agree, Bilo, that is what the SEC is talking about. Maybe you don't believe that, but that this is what the regulators are doing. And I think that's why they're getting pushback.
Sure. No, again, maybe I'm not being clear. I'm not talking to their motives. I'm saying that the reason we're all here talking about regulation is because of what happened with FTX. Just to take it into context, the context is FTX and the safety of consumer funds within an exchange. That's what started this whole conversation. Otherwise, there wouldn't be 20,000 people on this space right now. So I
but
agree
the
with
combo
you.
did veer into talking about different asset classes and who should be allowed.
Sure.
100% went there.
Yeah. And I of course, it's a complicated topic with many facets, and I don't think that could be all summarized into one solid point. But when it comes to the safety of the consumer, This is where I feel like regulation is needed. Not at all when it comes to
Hey, let me.
the regulators imposing where I can or can't invest. I am totally against that.
Hey guys, I'll chime in here. Great discussion, and yes, there's a lot more nuance that's required here. First off, I published an op-ed last month in the Wall Street Journal with former SEC Chairman Arthur Levitt, longest-serving bipartisan SEC chair. It was critical of Gensler, so it's really SEC chair versus SEC chair. I did post it in this tweet thread. You can take a look at it, at a quick summary of the challenges and a proposed path to resolution. But first off, just going back to first principles, I think there's a lot of people kind of talking past each other here. So in the US, which I'll restrict my comments there is a presumption of freedom. And to the point that was raised earlier, the securities laws in the US are based on a disclosure regime. So it's the idea that, hey, you can raise money for whatever you want, provided that you disclose risk factors. And we call that, in a private offering, an unregistered securities offering, a private placement memorandum. In a public offering, we'll call that an S1 filing, or what's also known as an IPO. So that's just the facts of the land. There's a lot of delicious irony in all of this, because if you live in a disclosure regime, then it's not the job of the SEC to make sure there are no frauds, because the job of the SEC then is to interpret the law and enforce and catch bad actors after milk spills in aisle number 5. The alternative to that disclosure regime, which is a presumption of freedom and the ability to make bad decisions, and yes, we have to improve things like the accredited investor rule, which makes no sense, right? The alternative to that is you have a severe licensing and registration regime, which is, for example, what banks are subject to. We can't go start a bank tomorrow without having bank examiners on site and have the ability to access information and approve new products and so on and so forth. That's a very different regime entirely. So then what are the challenges and mistakes that Gensler and the current SEC is doing? Well, first off, there are these nuances, right? So the Howey test has worked generally well for the last several decades. The issue is that now you have these tokens like Ethereum, and Ethereum started as a security because there's an expectation of profit, number one. There was a team, so you relied on the managerial efforts of others. And 3, you made an investment with an expectation of return. However, now that time has passed and Ethereum is decentralized, you no longer have an asymmetrical information problem. You no longer have a central team you're pointing to. So there are these really subtle things going on, meaning can a token start as security and no longer be a security? That's one, for instance, of this kind of nuanced area. Another nuanced areas are on NFTs. Can you have a digital collectible that is, and what's the distinction between a digital collectible that is a security or simply a piece of digital art? So that's where the nuance lives. But the path to resolution around this is, and this is what we argue in the op-ed, which I'd recommend you all take a look at, is a self-regulatory organization, an industry-led self-regulatory organization in the spirit of FINRA or Peekaboo. If you recall, Peekaboo was established after the fraud of Arthur Andersen and Enron, and FINRA is the regulatory body that oversees broker-dealers. It would still have oversight from the SEC because the SEC should regulate securities. And we want tokens to be securities because then we have an expectation of profit. That's another delicious irony around crypto. We want to make money investing in securities because they generate earnings and revenue, they can compound book value, and they can issue dividends to investors, and that's exciting. So that's a proposed regulatory path forward. The point raised earlier that Congress has the ability to create a new framework here, like you're seeing the Loomis-Gillibrand bill, is a very good one. But yes, Gensler can do more to create clarity now, namely by issuing interpretive guidance.
It doesn't. Those are wonderful, fantastic, amazing points and explanations. You did like I think that was extremely lucid and very, very clarifying of what exactly is happening with the SEC, the different regulatory regimes. Nobody at the SEC is trying to tell you whether or not you should invest in something. I mean, the most that we ever did was pass around some of these ridiculous offerings and being like, are these people actually going to get, what do like house odds, like, is anybody going to invest in this? But it's not the government's job to tell you whether or not you should invest in it. It is only the government's job to make sure that everything is disclosed, right? To the, you have to attest and verify, which is different from financial attestation. Legal attestation is different. You have to attest that these are all true and correct, and everything is in there, and that's where you get fraud claims from, because you basically lied, that they're material misstatements and omissions. But people have a shot at anybody can invest in something, however stupid or wonderful, as long as the information is there and they went through the system so that it protects you should something go wrong. Right now, if all you're being protected by is a crappy copied white paper from that has it doesn't even have the right the terms for all of the tokens that are in there, then that doesn't help you at all. Right? What you want is something that fully discloses what the project is, and that protects both the project and the investor. And we should be actually asking for that more than anything else. But there is the 2 points though about whether or not the something can start off as a security and then not be a security any longer, I think is a really interesting point. And that is something that Hester Peirce has been trying to argue for a very long time with no traction. But I do think that fundamentally under this new regime, there will be the ability to have more of a continuum of whether or not what happens when something becomes a security. And it's because it's a risk-based approach. So basically when you reach some level of risk, when the risk minimizes to a certain extent, then it becomes something that is something investable by retail, et cetera. It can start off not as a security in the first place. And then the second thing about NFTs, absolutely, some NFTs are securities and some are not. Not everything is like an all or one thing, but we definitely have a bunch of different areas where securities, like you may apply securities law if it is a security. Remember also, some of the things that want to become currency, there's a whole other regulatory structure for that. So you may not be subject to the SEC, but that doesn't mean you won't be subject to some regulatory structure. So you just have to be careful, like knowing what you're trying to do, and then picking your fundamental design, and then you figure out which structure is going to govern this particular project, and then you just kind of build from there. That actually is something that seems to be working more.
Jeffy, just jump in, guys. Yeah, go ahead.
And what she's talking about, okay, and what she's talking about is absolutely right. I've been a day trader since 2008, so I've gone up and down, and it was a perfect time to get in the market and lose everything. My concern with government regulation, and remember, it's not the SEC that makes the rules or the laws. It is the federal government. We have senators that, the last time they brought cryptocurrency up for a hearing, one of them asked where he could physically get a Bitcoin and hold it physically.
Wait. Remember the Let's Make Our Wallets? That was Brad Sherman. Let's make our wallets.
Oh my God!
You remember that?
Yeah. I turned it off and stopped watching and went for a walk and said, "Well, we're done," But what happened in 2008 with everyone losing money? The Dodd-Frank Act came about, and in many ways, the intention of the Dodd-Frank Act was to protect the little guy, but as far as that regulation, like the Dodd-Frank Act actually caused a mass amount of divorces in the United States, because there was part of a compliance rule, and I was one of the divorces. There was part of a compliance rule that said if anyone in your family works for a bank, then the other people of the family, the husband or the wife, the children, they're not allowed to invest in the market in much the way a day trader would. Now, that's not what it said in the law, the Dodd-Frank law, but the massive bank that my ex-wife worked for interpreted that compliance regulation and literally one day took over my account and froze it for 14 days while they moved it into another system so they could watch every transaction that I made and tell my ex-wife if she was in violation because I had made a trade. Now, the logic behind that is essentially, if money's energy, money can't be created or destroyed. It only changes form or hands, as the case may be. In 2008, when a whole bunch of firms lost big, there were a whole bunch of children and wives of massive hedge fund managers that, interestingly enough, about 6 months prior, opened up a trading account and shorted the market to the tune of $250,000 or more, and then they made a killing. And that's why it was designed to prevent that from happening. But what it did was it gave this massive bank the opportunity to lock out over 1 million accounts of people who were investing in stock A or stock B, and artificially cause the float to halt, certainly in one way, so that the company could then come in and buy more of the stock, and then it would go up. And then they'd sell it off, and they'd lock it out again. And the reason why I can only say the corporate bank is because I and my trading partner, we identified this problem because I had been working for about 3 years to try and be allowed to just trade on a, quote, free and fair market. And I wrote down exactly how the bank was an underwriter of a certain company, and they were locking out the stock to everyone in the company. They weren't allowed to trade it, buy it, or sell it. And then the company would come in when the stock was down and purchase a massive amount of shares. And then stock would go up, the bank would lock it out again, and the bank would sell a certain amount of shares for a profit. And that happened over and over and over and over and over again. I sent this detailed form filing to the bank, and their response was to ban me from all corporate property. I talked to an attorney the next morning, and they fired my ex-wife and walked her out of the building. And I sent this to the SEC. I sent this to FINRA. I sent this to senators. Nothing happened. But my fear with regulation is part and parcel that there is going to be so much regulation applied to this that, regardless of intent, for it to be helpful to the salt of the earth person, I think it will, as many things in American society do, advantage the wealthy and take away that advantage for the people who are just trying to get started. When the American stock market started, it was known as, this is the fastest way. I mean, not when it started, but when they finally let anyone essentially invest in the stock market, it's the fastest way that money goes from the impoverished to the people of wealth. And crypto has been an offset of that. And it has caused, they're talking about slowing down the wealth effect in the United States. That's code for there are too many poor people that have savings now and are not working themselves to death in order to basically pay the right to live and eat and have shelter. So there's not enough money moving up. And this is one of the things that, with regulation that's not done in a diligent manner, I fear personally can squash a lot of people who have $200, $300, $3,000, $4,000 total that they're trying to aggressively make money with, or passively, and squash them out. The other thing that I wanted to just briefly comment on, I completely forgot because I talked too long. So I'll give it over to the floor.
Well, if I may, guys, I just want to
Can I
talk about.
say something?
If I may, I just want to mention 3 points. The first one is, the free market and regulation. The second is, U.S. and regulation arbitrage, and the third one is the principle-based approach of Switzerland, right? So the first one is basically the problem with a lot of free market enterprise systems is that they see regulation as barriers to entry. And then you can basically use regulation to essentially stop innovation. And that's basically what happens with all of these securities laws in some form, because, for example, first of all, we need to define that, you know, the moment you're a security, you need a prospectus, and you have to be traded on only on regulated exchanges. So that already clears up a lot of things. You're centralizing a lot of things here. The second thing is, and by the way, Bitcoin, as far as I know so far in the US, I'm not an expert, but I think it's the CFTC, it's not the SEC. But then I'm sure the SEC is looking at the other crypto assets, right? So that's one, right? It's like barrier to entry is one. And second is the regulation arbitrage, you know, because essentially whenever you see too much regulation in one place, the only thing you're going to achieve is people going to another place. And there is always going to be differences in regulation, right? And so it might not be helpful when you want to create value. Now, the Swiss approach, and this is, you know, I'm a commodity trader, so I used to deal with commodities, and the Swiss approach in terms of regulation, first of all, it's always been driven by the people. It's a direct democracy here. So you don't have these angels who decide better than the people what to do or what not to do. In this sense, it's a little bit more, you know, and we're educated people. Most of them do not want confiscation or Bolshevism, right? So it's pretty sensible, right? And the principal approach also says that, you know, in a way, there is a big difference with the Swiss law where it says, well, corporations are moral entities and they have responsibility, but they don't really exist. People have responsibility, you know, institutions don't have responsibility. So also when you start having a regulation where people also bear the burden of you think twice before making a mistake, right? So that's also very important, because you say, oh well, it's all the moral entity and it's all the corporation. Of course they need to pay, but because they have the most money in treasury most of the time. But if the people are also starting to suffer, then you know you'll think twice before you do any wrongdoing. And then finally is when you go to court, it's going to be more about the principle and not necessarily some loopholes in the law of, well, he did something wrong, but as far as the law is concerned, it's okay. No. It's got to be something like, on principle, the guy did wrong. There's very little laws, but they can be interpreted by sensible people, and they say, look, this is it. And finally, my company, for example, it's an SRO, it's a self-regulated entity. It's supervised by FINMA, but what it's mostly supervised by, it's actually the industry. It's most of the other people who are like, hey, hold on a minute, we're all in the same boat here. If we allow, as entrepreneurs, as a group, as this crypto nascent thing, and we see a lot of wrongdoing in 2017, if we allow wrongdoing, then we all gonna lose. So it's also about the industry itself, who I think knows much better than the regulators, to set up like sensible, you know, commonsensical rules where they say, hey, look, you know, we need to watch out for each other, because otherwise we're all gonna we're all gonna fall. And so I think the principles you want to keep here is, you want to allow a free market enterprise system where regulation doesn't prevent competition and barriers to entry. You want to have something where those who know better, like you were speaking about the Senate, like they didn't know a physical Bitcoin, and so they can say, hey, look, guys, it's in our own interest to have a good reputation, right? And so I think that's really where you're gonna start, like having it. And then finally, if you make a mistake, because regardless of how much you regulate, there's always gonna be bad players. The most important thing is to bear responsibility where responsibility is due. And if people carry that responsibility personally, you know, because the companies don't exist, it's every single person carries responsibility. You know, the big problem with the state and statists is that whenever they do something wrong, it's never it's never the president, it's never the parliamentaries who suffer from the mistake. Look at COVID. Did they suffer from people closing their business? Did anybody were they the ones suffering from starvation in certain countries because they were keeping their jobs out of it? No. So it's got to be both ways. It's got to be regulators carrying responsibility, and then the people who are in industry to also watch out for each other and have principle-based regulation. Yeah, that's what I wanted to say.
I'll give the mic
Yes.
to I'll give the mic to King and Bilo for the final words. For everyone in the audience,
Thank you
we'll
very
get
much.
back. Oh, good, bro. We'll get back to the show tomorrow again after this discussion. So if you want to turn on reminders for tomorrow's show, it's pinned on my profile and it's pinned above in this space. So you just turn on reminders so you get notified. So we'll be discussing. I don't know. Every time we come up with a topic for the next day, it ends up changing throughout the day just because of news comes up and fucks everything up for us. Go ahead, King.
Yes, I partially agree with Theory and the guy who was saying earlier that we don't need any type of legalization or like that affects our freedom. So, but at the same time, we need some form of regulation to stop like all the scams, and because I'm pretty sure everyone over here has lost money to at least thousands, maybe tens of thousands of drugs have happened in crypto, but there is no mechanism to uh, legally, take action against those drugs.
No, I
Even
agree. And like someone, I just before you
yeah,
continue, someone mentioned earlier, like, hey, but the same thing happens in other markets. Yeah, but not to the extent of crypto. Like crypto, not in
exactly.
terms of numbers, crypto small, but in terms of percentages. Like every fucking project was just. At
Even
one
the
stage, someone said the majority of projects were rugs, which is insane.
exactly, even on the largest exchange, even on Binance, there is a rug listed. Like, um,
Less
it's
so, less so. Binance has self-regulation. Centralized exchanges against centralization's pros, and some
yes,
might
but
argue.
I yes, but it apparently it isn't working the regulations because a project on Binance rugged like 3 years ago. After the rug, a year after rug, someone from team took over the website and used it to run a scam. And I wrote to Binance a year ago, and a lot of people were also writing to them, but um, that project is still listed.
Talking about
And
Binance, just got news that Forbes got a just quickly, bro. Forbes got a 10 days ago. They got a. Oh no, that was a while ago. Sorry. Now go ahead. I thought I had breaking news, but it's not. Yeah, continue about the rug
yeah.
project on Binance. Yeah.
Okay, so it's a project called GTO. It was the first ever Binance Launchpad project. It launched in
Yeah, I
December
understand. I understand. No
2017.
need to get into detail, but the point you're making, though, bro, is that a project, even if it launches on Binance, you're having rugs and we need
Exactly,
regulation. Yeah, I
exactly.
think there's going to be outliers. Like you talked about one outlier, whereas I said the majority of NFT projects, someone told me, were rugs. So I think it's when with self-regulation works to a certain extent. We invest in projects once they get confirmed to be listing on a respected centralized exchange, because we assume they would have done their due diligence. Obviously, FTX shows us that this is not always the
Yes,
case.
exactly. That's
But
the
yeah,
point.
I agree. We need regulators to a certain extent. I'll let Bilo and Umbrella just kind of finish the final 2 points, guys, just so we could I can finally have a Saturday. Go ahead, Bilo.
Yeah, nothing. Just kind of to keep everybody should just keep in mind that crypto Web3, call it what you want, is really early, and we need more onboarding into the space. I've said this before. Onboarding into the space is not going to happen with non-custodial wallets, DEX, DeFi. People are scared, and they're going to be very uncomfortable for their first interactions to be in a decentralized fashion. So why am I kind of insistent on this point of making centralized exchanges more safe is that centralized exchanges are the most, I guess, broad highway leading into Web3 for newcomers. So we really need to find solutions. These solutions don't necessarily have to be government regulators, but some sort of regulation I still believe is extremely important for the survival of the space.
I
And for
agree.
new
I agree. It's
liquidity to
part of
come in.
it'll help adoption for sure. I think it's as we've seen with every argument, it's always somewhere in the middle. I think regulation, most of us, if not all of us, are aiming towards decentralization working to be a successful experiment. I think centralization and regulation will kind of allow us to get there faster to avoid things like what we've experienced recently. Umbrella, final words, my friend.
I think final words for me is we'll probably see more, collateral damage in the coming days. I've heard rumors of, some big names that have been hit by this, and I think kind of more is going to come out. And don't be surprised if we hear some one or two more big names, but bar Genesis, which you've already heard of, coming out, and they're in trouble.
Yeah, DM me what you've heard. Obviously, we won't share them here until we verify them, but definitely hit me up. I think, do you have my WhatsApp, Umbrella, or no?
No, I have DM'd you
Cool.
on Twitter. I have DM'd you on Twitter.
I'll send you through. I'll get my team to send you through my WhatsApp. So I'd love to see what you have, and it'd be good to have a direct line of communication. But yeah, my takes, I'd agree with Umbrella just said, in that, yeah, there will be more pain. We get a lot of, we share some things that we get if we could verify them, but there's a lot of scary shit we get that we don't share. Mainly because a lot of it is, just, FUD that's unverified and we cannot back it. But in other cases, it could be, where there's smoke, there's fire. So we'll share what we could verify. And I know a lot of you would like us to share everything, so at least you get, you kind of find out in advance if there's an issue, better be safe than sorry. But at the same time, we do have a pretty big stage. So obviously, if we share incorrect information, it could become a self-fulfilling prophecy. Go ahead, Chet.
Just one thing that came through from Fox News here, interestingly enough, about Evan Luthra.
That's your first Evan Luthra.
Yes, Evan Luthra. So Evan Luthra actually apparently lost money in this debacle as well. So he, it says here, he lost $2 million in the disaster. He said, quote, "This is a big lesson for everybody in the crypto community." On Fox News Live.
How is my boy Evan Luthra on Fox News about losing $2 million?
I know this surprised me too. That's why I brought it up here. So it said it's a big, strong lesson that not your keys, not your crypto. If you don't hold the keys to crypto, it's not really your money. He said. He also responded. Fox News says Luthra also responded to new details in the Wall Street Journal that SBF pocketed nearly $300 million from funds raised last October, slamming the former CEO for using the exchange as, quote, his personal bank account. Luthra said this was all...
Evan Luthra is breaking news. I'm just DMing him now for losing $2 million. That's so cool.
Luthra said this was all intentionally done and said this was a very calculated plan, or should I say a crime that has taken place. He said you could have a car manufacturer who cut some corners and then defrauded the industry. Doesn't mean electric vehicles are bad. So it's like Bitcoin by itself. The fundamentals are still very strong. And if you have Bitcoin in your hard wallet, in your hand, you have not lost any money today. He said, from all this fiasco, I've already come to realize that Sam Bankman-Fried is a bad actor here. We already know that this is a bad actor. This is a fraud, and this is a criminal. He says, you can't blame the government for accepting donations without knowing this was going to be criminal. You can't really blame anybody in this case except Sam Bankman-Fried, who is cruel, who intentionally planned and executed a fraud against the whole community and everyone involved. He said, but the right thing would be for them to give the funds back, whoever got the donations, and should go back to the victims whose funds it really is. Finishing here from Fox News, the last quote here they have from him was, "This was never his money to give away. This was our money."
So some of that money will be clawed back, though. And I sent another article after that was about the payout structure, which is probably too detailed to get into before we close here, so that everybody can get rest. But they're talking now. There's some solvency in a number of the subsidiaries, and so now they're talking about in terms of. Okay, the money should go back and then it should go to the creditors. Well, how does that happen? Does it go back to the creditors to, what do you call it? Does it go back to the creditors who are involved in that particular subsidiary, or is there going to be one large pool? And that matters
a huge amount. Actually, that's going to determine whether or not most creditors get paid out, which is what you are if you had money in FTX, or whether or not you're going to end up with nothing. So that's something to follow if you are involved in FTX.
Yeah, so I'll just tell the audience just quickly for tomorrow's show, just check the pinned tweet on my profile and check the pinned one above in the space, just a space to turn on your reminders. I'll give the mic to Piotr. You wanted to share something. Is Piotr there or he dropped out? Oh shit, he wanted to share something but he dropped out. Oh, there he's coming.
Can I?
He's
That's
coming.
awful.
No. Let me add him in now. But yeah, so I'll let Piotr jump in to share what he wanted to share. Piotr, you want to share something with the audience?
Yeah, well, first I want to hear from his G20 contacts that he invited to join the chat. I'm still waiting to hear from his
Tomorrow,
friends at the
tomorrow.
G20.
We have it tomorrow.
I'll give a couple of things. So what I'm going to
Well, we'll cover, before you do, just tomorrow, guys, we will cover G20, the Twitter debacle. Hopefully we'll have time to cover that unless there's breaking news. But yeah, go ahead, Piotr.
Yeah, no, as I, some of you maybe see me sitting on stage, don't say much. I speak when I think I can add something of value, even if it is too much, as Kim thinks sometimes. All well and due. I respect Kim's positions, and I think it's good to have a diverse panel where we can have head-to-head debates and clash sometimes, but still come away taking little snidey stabs at one another. I think it's quite entertaining. So I appreciate you, Mario. Appreciate chat. Appreciate you guys listening. Just a couple of points. So one, there's a couple of things from the crypto scene. The G20 were meeting for the past couple of days this week in Bali in Indonesia. So what I've been doing is trying to understand some of the broader implications of that for you guys. We talked about global regulatory frameworks and that sort of thing. So I want to go into that. And then I might bring up a couple of things from the Ukrainian developments if you're interested. I'm not going to turn this into a political room, don't worry. But I think it's important to keep in mind some of the developments from a geo-economic standpoint and what that means for, again, the crypto scene. It's all interrelated at the end of the day. So what I will do is I will outline some of the main headlines. I will give you the bullet points. I won't give you my opinion. I'll just give you the headline, and then we can, if Kim wants to pick up a specific point and say why this is, stupid, then we can go into a specific debate segment. But what I want to do is just outline the overarching status as it is, what policymakers are thinking, what politicians are doing, and then we can have an actually more subjective, debate section. I think it's a good way to distinguish between elements of the conversation. The last thing I just want to mention is that if you are interested in geopolitical stuff, I do host a lot of rooms on that on Twitter Spaces. So tomorrow I'm going to have one discussing the Belarusian Russian element and what that's done. And given that those two countries are quite big into crypto mining, it might be of interest. And then next week, I do have a gentleman called Alexander Vinman, who was the former director of the National Security Council to Europe from the United States. He was very well known for the statements he gave over Trump's first impeachment. So he's going to be joining us on Monday, the 28th of November. So if you're interested, you can find some of those events on my profile. But with that, very last thing is also, I do have a podcast. I talk mainly geopolitics, but there's a good episode on Chinese, Russian relations, and one episode which was about whether the two countries can produce a different financial market system. So if you want to check that out, the podcast is called The Global Gambit, and you can find it on my Twitter feed as well. But thanks a lot, Mario, and I'll see you guys.
Just for fun, Piotr, the Vinman, Lieutenant Colonel Vinman, was the guy that whistleblowed on Trump for the Ukraine call.
Yeah. No, I know. I'm meeting him in person in DC, so very excited to have a in-person chat with him, and I hope you guys can. If you guys have any questions, please DM me, and I'll filter through them and try and get us. I like to. How I do my podcasts is I have about half an hour of one-to-one, and then I bring some people up to ask questions and engage, because I think it's much more of an opportunity for audience participation, which is much healthier than just stuffy policymakers talking amongst themselves. You've got to hear from everybody. But anyway, thanks a lot, everyone, and see you tomorrow.
Cool. All right, Tim, Mad Scientist, any quick final words, guys?
Yeah, really happy to listen in. I was listening for about the last hour. Really appreciated the conversation on regulation. I think it's really key here that coming together and figuring out what as an industry and community we really want is really key to having an outcome that leads to a lot of the advantages that crypto could actually provide the public. So I think that's really important. Yesterday I had a bunch of more thoughts. I didn't get to finish what I was saying, so I actually wrote those up into a blog post. So if anybody wants to read that, that's pinned on my profile. I'll be posting more and just kind of covering a lot of the stuff that I wouldn't actually say because it would be me talking for like 15, 20 minutes, and I don't want to do that. So happy to share that way as well as participate in these conversations. I'm really grateful to everyone. Thank you.
Cool. Mad scientist, go ahead, bro.
Yeah, we're shutting down, but we've been spending the last few days, obviously heavily focusing on what has happened and what is happening and all the current news. We know the regulators move slowly, and we know that they aren't always, at least in appearance, in line with the directions that we want to go. So I think one thing that we all need to really be thinking about is what are our steps moving forward? What does self-regulation look like? And more importantly, how do we get there, right? How do we provide that transparency? We know it exists on chain. How do we remove the barriers of entry to get people down there? And what do we do either programmatically to provide some level of consumer protections, or developing just either a sort of trusted group of humans, right, to kind of emulate those levels of consumer protections that we currently have in the non-decentralized space.
Cool.
So
All right. Love it, man. And I appreciate you, man. I should join back next time. Guys, we did one on Saturday. Weren't planning to. Alexander's got final words. Alexander, Piotr again. Go ahead, guys. Let's end it with those two last comments.
Oh, come on, not Potter again, man.
That last argument, no. I just tweeted out, like, I think that even though we argue about things on the stage, I just wanted to say the people on here have been uniformly incredibly intelligent, well-informed people, that even when we disagree, I still think people are getting way more information about both sides than they would in any other static site. So I really appreciate this site. People don't have to agree on everything in order for it to be useful. It's actually more useful because we don't all agree, and we are able to express the differences. Like, we've heard about different regulatory structures that could exist, the different issues that exist for people, that are small versus large investors, small versus large companies. It's really incredible. It's a huge amount of perspective in a very short period of time. If you're confused about any of the base concepts here, I have a podcast called Crypto Immersion. It's just informative. It's just, there's no bias. I'm not selling anything. It's just like a informational site that will give you all the information so that you understand more about blockchain if you're coming to this site but don't have that background information. But I just wanted to say thank you again for even inviting me on this. I have a perspective that not a lot of people in crypto always appreciate, but I think it's a useful and important one. And I really
just remember, Alexander, the audience 50-50. 50% was more on your side, 50% on the opposing side. So it's very split in the audience.
Good for you guys. No, I'm kidding. I do appreciate it, though. I think that the ability of everybody here to be able to express their views without worrying about being attacked or anything like that for it, I think is just, you guys are doing an amazing job hosting, and I'm so glad we have this space.
I appreciate it. I do have breaking news. There's an animal called the long pigeon pheasant, black-naped pheasant pigeon, has been spotted since 1882, and it was just spotted in Papua New Guinea. That's the shit I like. I love animals, so that's better breaking news than another bomb in Poland or another fucking fund collapsing. The black-naped pheasant pigeon is spotted again since 1882 in New Guinea. Probably should do a space on that.
That's the
most
guys. Peaceful breaking news I've heard.
Yeah, but that's the only piece of news I've opened for the day. I've actually got it open. I want to go through it. I love it. Piotr, final words before Kim goes crazy, and then we'll end the show.
Yeah. I've got breaking news. The Financial Directors Commission of the UK has just decided. No, I'm joking.
Shit.
I just wanted to say my podcast is in the nest above. If you want to check it out, everyone. And those of you suddenly message me saying, "Do I take recommendations for guests?" I do. Please, if there's someone you want to hear from, then reach out to me with speakers, and I'll see if I can get them on. But anyway,
cool.
Take it easy, guys. Have a great evening.
Love it, guys. Thank you. Go ahead, Kim.
I just have one quick question. Since you've plugged every single channel, what was your OnlyFans again?
I've got it open, Kim. I'll send it to you now. I've got it open in front of me. I'll send you the link right now. All right, guys, I'll call it a day. Thank you so much, everyone, for joining on the weekend. And yeah, we'll see you all tomorrow. Hopefully, not too much shit goes on between now and then. Bye, everyone. Love you all.